world of cryptocurrencies was never in better spot. New financial era is right in front of us, and this is the perfect time to take advantage. And by the end of this video, you will go from knowing nothing to understanding absolutely everything you need to know about top 10 cryptocurrencies, and those are Bitcoin, Ethereum, XRP, Solana, Cardano, XLM, Binance Coin, USDT, USDC, and Dogecoin. So without wasting any more time, let's dive straight into explaining history of our first currency for today, which is Bitcoin, of course. So without wasting time, let's start with birth year, which is 2008. If you really want to understand Bitcoin, you have to go all the way back to 2008, not just to a technological beginning, but to a global moment of deep financial anxiety. This was the year that trust in the banking system completely collapsed. Lehman Brothers fell. Massive institutions went bankrupt. Ordinary people watched their life savings disappear overnight, while governments rushed in with trillion-dollar bailouts to keep the system afloat. It was during this financial storm, on October 31st, that a short 9-page document quietly appeared on a cryptography mailing list. The author called themselves Satoshi Nakamoto, and the title of the document was simple: Bitcoin, a peer-to-peer electronic cash system. There was no marketing campaign, no launch event, just an idea that would end up challenging everything we thought we knew about money. The white paper laid out a method for sending value across the internet without needing a bank or payment processor in the middle. That idea might sound simple now, but at the time, it was radical. Instead of relying on trust in institutions, it used mathematics, cryptography, and decentralized consensus. In just 9 pages, Satoshi proposed a complete redesign of how financial systems could work, where anyone, anywhere in the world, could send money to anyone else without asking permission and without the risk of fraud or double spending. And importantly, the timing was no accident. Embedded deep within Bitcoin's early code is a permanent message referencing a headline from the Times newspaper: Chancellor on brink of second bailout for banks. That wasn't just a timestamp, it was a statement of purpose. Bitcoin wasn't created out of curiosity. It was a direct response to the failures of the financial system. But who was Satoshi? That mystery only deepens the story. No one has ever definitively identified the person or group behind the name. Some believe it was a single brilliant programmer. Others argue it must have been a team. Theories have ranged from cryptographers like Hal Finney to academics like Nick Szabo to even rumors involving the NSA or other intelligence agencies. Australian entrepreneur Craig Wright famously claimed to be Satoshi, but has never provided convincing cryptographic proof. Despite endless speculation, the truth remains locked away, possibly forever. And yet, from that small, anonymous beginning, an entire movement was born. Bitcoin wasn't just a new kind of currency. It was a challenge to everything centralized, a way to exit a system that had failed so many. And even though it would take years for the world to catch on, that quiet moment in 2008 would eventually reshape the entire global financial landscape. If 2008 was the spark that introduced the idea of Bitcoin, then 2009 was the year it came to life, silently, without fanfare, but with a message that would echo across time. On January 3rd, 2009, the first ever Bitcoin block was mined by Satoshi Nakamoto. This block, now known as the Genesis block, was more than just a line of code. It was the beginning of a new kind of financial system, one that didn't rely on central banks or governments, but on a decentralized network of computers running open source code. That first block didn't just mark the start of Bitcoin's technical existence. It also carried a clear political message. Embedded within it, written directly into the raw data, was a headline from the British newspaper The Times: Chancellor on brink of second bailout for banks. It was a quiet but powerful signal, a commentary on the broken legacy system, and a declaration of purpose for what Bitcoin aimed to replace. This Genesis block carried a reward of 50 BTC, but unlike later blocks, those coins were never spendable. Some believe it was a symbolic gesture from Satoshi, marking the block as something sacred, a starting point that should never be touched. Just days later, on January 12th, the very first Bitcoin transaction took place. Satoshi sent 10 BTC to Hal Finney, a respected cryptographer and one of the few early supporters of the project. That moment wasn't just a technical success. It was proof that value could be transferred between people over the internet with no bank, no third party, and no permission. It was a glimpse into the future, but the world wasn't paying attention. In 2009, Bitcoin didn't have a price. You couldn't buy it on an exchange. There was no Coinbase, no Binance, no mainstream media coverage. Bitcoin existed only in the corners of internet forums, among cryptography enthusiasts and digital idealists who saw something revolutionary in its design. It ran quietly, block by block, every 10 minutes, without stopping. A machine that no one could shut off, maintained by volunteers who believed in its vision. There was no roadmap, no guarantees, and no idea of what it would become. But the foundation was now set in stone, or in this case, in code. That first year was not about growth or headlines. It was about survival. The network was small, fragile, and vulnerable, but it worked. For the first time in history, a truly decentralized financial system existed, not in theory, but in practice. It was still just a baby, but Bitcoin had taken its first step, and history was already in motion. We reached topic number 3, and it is a significant one. Year is 2010, and Bitcoin has the price value for the first time in history. At some point, every invention has to leave the garage and step into the real world. For Bitcoin, that moment came in 2010, the year when it stopped being just a fascinating idea among cryptographers and finally gained a price. It was the first time this invisible digital currency was exchanged for something tangible in the real world. That moment is now legendary, and it involved something as ordinary as pizza. On May 22, 2010, a developer named Laszlo Hanyecz posted an offer in a Bitcoin forum. He would pay 10,000 BTC to anyone who could get him 2 large pizzas delivered to his home. At the time, Bitcoin didn't have a market value, so 10,000 coins sounded like a playful, generous amount, more like tokens in a game than anything of actual worth. But someone took him up on it. A user from England helped coordinate the purchase, and soon enough, 2 Papa John's pizzas were delivered to Hanyex's door in Florida. In return, he sent over the 10,000 BTC. It became the first documented real-world purchase using Bitcoin, and it gave Bitcoin its first price, about $0.003 per BTC. Today, those 2 pizzas would be worth hundreds of millions of dollars. That day is now celebrated every year as Bitcoin Pizza Day, a quirky but powerful reminder of how far Bitcoin has come. As this story spread among early adopters, something began to shift. People started to see Bitcoin as more than a science experiment. It had value. And when something has value, people begin to trade it. Soon, rudimentary markets started forming. Online forums hosted informal trades, and peer-to-peer exchanges emerged. Later in the year, a more formal exchange launched, MT Gox. Originally created to trade Magic the Gathering cards. Yes, really. MT Gox was repurposed into a Bitcoin exchange by a programmer named Jed McCaleb, who is one of the founders of Ripple XRP. The platform quickly became the central hub for Bitcoin trading, and would later play a major role in Bitcoin's early rise and eventual scandal. But in 2010, it was a key milestone. Bitcoin now had a place where anyone could buy and sell it. Back then, things were still incredibly rough around the edges. Wallet software was basic, user interfaces were clunky, and security was an afterthought. But for the first time, Bitcoin had a market. It had users outside the original mailing list. It had a price people could look up. And with each new block mined, it was steadily building the foundations of a parallel financial system. This was the year Bitcoin made its debut as money, not just as a network or a concept, but as a currency someone used to buy dinner. And even though that dinner might have been overpriced in hindsight, the message was clear. Bitcoin had officially entered the economy. Everything was set. Now it was time to grow. And that brings us to topic number 4. By the time 2011 arrived, Bitcoin had already taken its first steps into the world. It had been mined, traded, and even used to buy pizza. But 2011 was the year it truly started to grow, and not just in terms of price, but in visibility, competition, and controversy. This was the year when Bitcoin crossed a major psychological milestone. One full Bitcoin was finally worth $1. It might not seem like much now, but back then, it was a big deal. It meant that Bitcoin, this strange internet money born out of a cryptography forum, was starting to be taken seriously. For the first time, people who had mined or traded Bitcoin early on were beginning to see real-world returns. But with growth came exposure, and with exposure came new risks and new players. As Bitcoin's price rose and its story started making waves online, the media began to take notice. Publications like Wired, Time, and Forbes ran their first pieces on the mysterious currency. They weren't always positive, but they were curious. The general tone was, what is this thing, and why is it gaining value? Bitcoin was becoming more than just a technical curiosity. It was entering the public conversation, but not all attention was welcome. This was also the year Bitcoin gained a controversial use case on the darknet marketplace Silk Road. There, Bitcoin became the primary currency for anonymous transactions, including the purchase of illegal drugs. For some, this was proof of Bitcoin's power, a decentralized currency that couldn't be censored. For others, it was a warning sign of what could happen when money existed beyond government control. Either way, the story of Silk Road and Bitcoin became intertwined in the public eye, and it sparked intense debate about the purpose and future of digital currency. Meanwhile, the crypto ecosystem itself started to evolve. Inspired by Bitcoin's open-source nature, developers began creating their own digital currencies, alternative coins or altcoins. Among the earliest was Namecoin, designed to decentralize domain name registration. Then came Litecoin, launched in October 2011 by Charlie Lee, a former Google engineer. Litecoin promised faster block times and a different hashing algorithm, positioning itself as the silver to Bitcoin's gold. Ethereum soon followed, introducing a new proof-of-stake concept. Each of these projects aimed to solve what some saw as limitations in Bitcoin or to experiment with new features entirely. By the end of 2011, it was clear that Bitcoin had sparked a movement. It wasn't just a single coin anymore. It was the foundation of an entirely new asset class, one that was rapidly diversifying, innovating, and yes, drawing attention from governments and regulators. Bitcoin had reached its first real milestone, becoming worth $1. But what that dollar represented was far bigger. It was proof that a decentralized currency could survive, adapt, and grow, even in a world that didn't fully understand it yet. We reached topic number 5, and if you like the value you are getting, I would kindly ask you to subscribe and like the video. Getting back to topic. By 2012, Bitcoin had survived its earliest tests and was no longer just a novel experiment among technologists. This was the year it began to mature. It didn't happen overnight, and it didn't make global headlines just yet, but the groundwork was being laid for the future of an entire industry. One of the most significant developments in 2012 was the formation of the Bitcoin Foundation. Its mission was straightforward: to promote and standardize Bitcoin, provide education, and fund development. This marked the beginning of an organized effort to present Bitcoin to the wider world in a more structured, credible way. Until then, Bitcoin had been purely grassroots, shaped by a decentralized swarm of developers and enthusiasts. The Bitcoin Foundation brought in more formal leadership, with notable early members including Gavin Andresen, one of Satoshi's direct collaborators. The idea was to ensure Bitcoin's continued growth and to provide some level of coordination without compromising the network's decentralized nature. But the real highlight of 2012 came near the end of the year, something that would become a recurring event in Bitcoin's lifecycle: the halving. On November 28, 2012, Bitcoin experienced its very first halving event. This is a built-in feature of Bitcoin's code, where the number of new Bitcoins generated with each block is cut in half. Before the halving, miners received 50 BTC per block. After the event, that reward dropped to 25. This reduction in supply was a crucial moment because it introduced a kind of programmed scarcity, reinforcing Bitcoin's narrative as digital gold. Unlike fiat currencies, which can be printed endlessly, Bitcoin's supply is capped and becomes increasingly harder to produce. It was at this moment that people started to realize Bitcoin wasn't just a currency. It was also an economic experiment in controlled issuance and deflationary pressure. At the time of the first halving, Bitcoin's price hovered around $12. It was still extremely volatile, still not widely understood, and still flying under the radar of traditional finance. But those who were paying attention began to notice a pattern. Just a year later, by the end of 2013, Bitcoin would climb to over $1,100. While many factors contributed to that explosive rise, the halving was a major catalyst. It was the first proof that Bitcoin's monetary policy could drive real economic effects. And it also gave birth to one of Bitcoin's most powerful memes: number go up. With supply cut in half and demand slowly rising, simple economics started doing its work. 2012 wasn't about hype or price explosions. It was about building. It was about creating the institutions, narratives, and mechanisms that would shape the next decade of Bitcoin's evolution. For the first time, there was a serious attempt to bridge the gap between Bitcoin's raw code and the real-world systems it was designed to challenge. The first halving wasn't just a technical milestone, it was a rite of passage. And from that moment forward, every 4 years, the halving would become a countdown for believers, a timer for cycles, and a powerful reminder that Bitcoin plays the long game. Everything was going well, but then first problems came, and they bring us to topic number 6. At the start of 2013, Bitcoin was trading at around $13. For those who had been involved early, it had already felt like a miracle to watch this open source project, born out of the ashes of the 2008 financial crisis, gain value and traction. But no one was prepared for what came next. Over the next 11 months, Bitcoin would experience its first parabolic rise. Fueled by growing media coverage, rising adoption, and the narrative of a new kind of money, Bitcoin's price surged to over $1,000 by the end of the year. That's nearly a 100x increase in just 1 year. It was a rush of excitement, greed, and disbelief. Suddenly, people who had bought Bitcoin for fun or mined it on their laptops were sitting on small fortunes. The world started paying attention, not just developers and libertarians, but investors, speculators, and governments. Much of the trading activity was centered around a single platform, Mt. Gox, which by then had become the largest Bitcoin exchange in the world. Based in Japan, Mt. Gox handled around 70% of all Bitcoin transactions globally at its peak. But even as prices soared, cracks were already forming. Users complained about withdrawal delays. Technical issues plagued the exchange, and behind the scenes, a disaster was brewing, one that would shake the community to its core the following year. But in 2013, the most immediate challenge came from overseas, from China. Bitcoin's meteoric rise didn't go unnoticed by Chinese investors, and a large portion of new demand was flowing in from China-based exchanges. The Chinese public was fascinated by the concept of an alternative to the yuan, especially one that was outside of government control. For a while, Bitcoin flourished in China, until December when the Chinese government intervened. The People's Bank of China issued a ban prohibiting financial institutions from handling Bitcoin transactions. It wasn't a total ban on Bitcoin, but it was enough to send shockwaves through the market. Prices plummeted, panic spread, and the narrative shifted from Bitcoin is the future of money to is this thing even legal? To make matters worse, Mt. Gox began freezing withdrawals that same month. Users couldn't access their funds. Rumors of insolvency began to circulate. Trust, which is hard-won in any financial system, especially a decentralized one, started to erode. Yet, in spite of all this chaos, 2013 was a turning point. It was the first time the world truly saw what Bitcoin could do, not just as a technical innovation, but as an economic force. The bubble may have burst, but it left behind a trail of interest, investment, and belief. New users had entered the space. Entrepreneurs began thinking seriously about crypto businesses. And most importantly, Bitcoin had proven it could capture the global imagination. And if you thought the trouble was over, you'd be wrong. Because what came next in early 2014 was a crisis that shook Bitcoin to its very foundation, a moment that not only tested the resilience of its technology, but also the faith of its entire community. The year began with optimism, as Bitcoin was still basking in the glow of its first big breakout. But that optimism would be short-lived, because in February, the unthinkable happened. Mt. Gox, the largest and most influential Bitcoin exchange at the time, suddenly went offline. For years, Mt. Gox had been the main gateway into Bitcoin for thousands of users around the world. At its peak, it handled over 70% of all global Bitcoin transactions. It was based in Japan and had grown quickly, but not responsibly. Its infrastructure was weak, its leadership inexperienced, and its internal systems riddled with vulnerabilities. Users had already begun complaining about withdrawal delays in late 2013. Then, without warning, Mt. Gox suspended all trading, shut down its website, and filed for bankruptcy. The bombshell soon dropped. The exchange had lost 850,000 Bitcoins, most of them belonging to customers. At the time, that was roughly 6% of all Bitcoin in existence. The cause? A combination of poor security, negligence, and possibly inside theft. Either way, the damage was done. The Bitcoin price, which had hovered near $1,000, crashed to around $300. The fallout from Mt. Gox was massive. For many, this was their first real introduction to the idea of self-custody. The notion that not your keys, not your coins wasn't just a slogan, but a survival strategy. Trust in centralized exchanges was shattered. People realized that while Bitcoin itself may be decentralized, the platforms used to access it often were not. This event planted the seeds for the rise of hardware wallets, cold storage solutions, and a broader culture of security awareness within the crypto community. But the Mt. Gox collapse wasn't the only thing shaping 2014. This was also a year of reflection and rebuilding. Developers and early supporters had to ask themselves hard questions. Could Bitcoin survive this public disaster? Would regulators crack down harder? Would users lose faith? Yet, amidst the turmoil, the network never stopped running. Blocks kept being mined every 10 minutes. Transactions continued to be confirmed, and the code remained unbroken. In a strange way, that stability became a quiet reminder of what Bitcoin was designed to do: operate without a single point of failure. It was during this time that people began to differentiate between Bitcoin, the technology, and the platforms built around it. The collapse of Mt. Gox didn't kill Bitcoin. In fact, it had the opposite effect. It forced the ecosystem to mature. It taught harsh lessons about risk, custody, and responsibility. And for those who stayed, it became a moment of clarity, a painful but necessary step on the road to true decentralization. By the end of 2014, Bitcoin had lost much of the spotlight it had gained the year before. Prices were down, media attention had faded, and critics declared once again that Bitcoin was dead. But the core community, the builders, the believers, the ones who understood the bigger picture, kept going because they knew that this was bigger than one exchange, one country, or one year. Bitcoin wasn't just surviving, it was adapting. And that, more than anything, is what would carry it forward. And it carried us to topic number 8. By 2015, Bitcoin was still recovering from the disaster of the Mt. Gox collapse. Confidence had been shaken, and prices were nowhere near the highs of 2013. But beneath the surface, something more important was happening. Developers, users, and miners were trying to figure out the future. Not just how to grow Bitcoin, but how to grow it without breaking the principles it was built on. And that led to one of the most critical debates in Bitcoin's history, the block size controversy. The question was simple. Bitcoin blocks had a limit on how much data they could hold, and that limited how many transactions could be processed. As Bitcoin became more popular, the network was starting to hit that limit. Transactions were taking longer, fees were rising. Some people believed the answer was obvious: raise the block size. Allow more transactions in each block, and you solve the problem. But others pushed back. They argued that raising the block size would make the blockchain grow too large and eventually make it difficult for regular users to run a full node. That would reduce decentralization. And to them, that was a much bigger problem than high fees. This disagreement sparked what became known as the block size war. Multiple new versions of Bitcoin software were released that tried to change the block size limit. Projects like Bitcoin XT, Bitcoin Classic, and Bitcoin Unlimited all had different ideas for scaling, but none of them were adopted by the majority of the network. What this period really showed was how difficult it is to make changes to Bitcoin. Even if many people agree, unless there is clear consensus, the network refuses to move. During this time, the second Bitcoin halving also occurred. On July 9, 2016, the block reward dropped from 25 to 12.5 BTC. Just like the first halving, it showed that Bitcoin's monetary system was working exactly as designed. Fewer new Bitcoins were entering circulation, and that scarcity was starting to matter more and more. So while this 2-year period might seem quiet on the surface, it was anything but. It was the moment Bitcoin had to decide what it wanted to be: faster and cheaper at any cost, or slower but stronger in its core principles. In the end, Bitcoin chose to stay small, for now. But the debate was far from over. It was only the beginning of a larger conversation about how Bitcoin would scale in the years to come. All right, moving to topic 9, which will bring major spotlight. By the time 2017 began, Bitcoin had already been around for nearly a decade, quietly building momentum. But this was the year everything changed. Bitcoin wasn't just a niche interest for developers or a playground for early adopters anymore. It was going mainstream. It was the year of civil war in the community, major upgrades to the network, and a price surge that would capture global attention like never before. But all of that didn't come easily. It came with serious growing pains. At the center of the chaos was the ongoing block size debate. The arguments that had divided the Bitcoin community for years finally reached a breaking point. After years of tension, a split became inevitable. On August 1st, 2017, Bitcoin officially underwent a hard fork. The result was Bitcoin Cash, a separate cryptocurrency created by those who supported larger blocks. It was a dramatic moment that felt like a family breaking apart. Suddenly, there were two competing visions for what Bitcoin should be. But the original Bitcoin, now more united around the idea of small, secure, and scalable steps, pushed forward with its own upgrade. That upgrade was segregated witness, better known as SegWit. This change didn't raise the block size, but it optimized how data was stored in each block. It was a major breakthrough that increased transaction capacity and laid the foundation for further innovations, including the Lightning Network, a solution designed to allow fast and cheap transactions off-chain. SegWit was activated just days after the Bitcoin Cash split and marked a critical moment where the Bitcoin community proved it could evolve without abandoning its principles. While the technical side of Bitcoin was transforming, so was public awareness. The second half of 2017 saw a wave of media coverage and global interest. Bitcoin was no longer a curiosity. It was a financial phenomenon. Celebrities, hedge funds, and even your neighbors started talking about it. The price reflected the hype. In December, Bitcoin hit an all-time high of $19,783 on Coinbase. It was a jaw-dropping moment for everyone who had been following the journey from its early days. What once cost fractions of a penny was now being compared to gold. But the price wasn't the whole story. What made 2017 so important was that it forced the community to face tough questions, make hard decisions, and adapt under pressure. It was the year Bitcoin faced its first civil war and survived. It proved that no single person or group controls it, that even when divided, the network can hold. And in the process, it earned a level of attention and legitimacy that no one could ignore anymore. And as the saying goes, the higher they fly, the harder they fall. Same goes for Bitcoin, and we will explore it in topic number 10. If 2017 was the year of dreams, 2018 was the year of consequences. The hype had reached a fever pitch in December 2017, with Bitcoin touching nearly $20,000. But markets don't climb forever, and what goes up, especially that fast, often comes crashing down. 2018 marked the beginning of what would be known as the crypto winter, a brutal bear market that wiped out billions in market value, tested the faith of investors, and separated speculators from true believers. In just a few months, Bitcoin's price plummeted, falling to around $3,000 by the end of the year. That's over an 80% drop. And it wasn't just Bitcoin. The entire crypto market followed. Ethereum, Ripple, Litecoin all saw their prices crash. Many projects that had launched during the 2017 initial coin offering, ICO Boom, promising to revolutionize everything from healthcare to real estate, simply vanished. It was like the dot-com crash, but for blockchain. Dozens of ICOs turned out to be scams. Others were poorly managed. Some never launched a product at all. Regulators stepped in, especially the U.S. Securities and Exchange Commission, or SEC, cracking down on illegal fundraising and securities violations. But perhaps the most defining feature of 2018 was the media narrative. Headlines declaring Bitcoin is dead were everywhere. In fact, it was declared dead over 300 times just that year. Critics said it was proof that crypto had been a bubble all along, just a speculative fad that had finally popped. But those closer to the space knew something else was happening beneath the surface. While prices were crashing, development didn't stop. If anything, it intensified. Teams went heads down building infrastructure, better wallets, secure custody solutions, and scaling tools like the Lightning Network. The Bitcoin protocol itself remained untouched by the chaos. Blocks continued to be mined, the network remained secure, and long-term supporters kept the faith. In many ways, 2018 was like a forest fire, painful, but necessary for growth. The scams were cleared out, the hype was stripped away, and what remained were builders, developers, and investors focused on the long game. Crypto winter wasn't fun, but it was vital. It revealed the weaknesses in the ecosystem, from poor security practices to unsustainable business models. It reminded people that Bitcoin isn't a get-rich-quick scheme. It's a technological and monetary revolution. And like all revolutions, it has cycles. Hype, crash, rebuild, repeat. By the end of 2018, the tourists were gone. The market was cold. But those still standing were stronger, wiser, and ready for the next chapter. Because if Bitcoin had survived this storm, it was clear. It wasn't going away. It was just getting started. And that brings us to topic 11. After surviving the brutal crypto winter of 2018, the Bitcoin ecosystem entered a quieter, more focused phase. One defined not by price action or media hype, but by infrastructure building and institutional curiosity. Between 2019 and 2020, the spotlight shifted from retail investors and speculative bubbles to long-term strategies, serious financial players, and maturing technology stacks. By 2019, the panic had largely subsided. Bitcoin's price had stabilized between 3,000 and 5,000 early in the year, and steadily climbed back above 10,000 by mid-2020. But more important than price was the shift in who was paying attention. This was the period when institutions began stepping in, not with empty promises or ICO white papers, but with real capital, regulated products, and long-term vision. One of the major milestones was the launch of Bakkt, a Bitcoin futures exchange created by Intercontinental Exchange, the company behind the New York Stock Exchange. Unlike earlier futures products, Bakkt's contracts were physically settled, meaning they delivered actual Bitcoin, not just cash. This gave investors more direct exposure and signaled rising demand for secure, regulated Bitcoin investment avenues. At the same time, legacy financial firms started quietly building out crypto divisions. Fidelity Digital Assets launched its custody services, giving institutional investors a secure way to hold Bitcoin. Grayscale, a digital asset investment firm, began attracting significant inflows into its Bitcoin Trust GBTC, especially from hedge funds and family offices looking for exposure without having to manage private keys. Meanwhile, the narrative around Bitcoin began to shift again, this time toward macroeconomic themes. In 2020, the COVID-19 pandemic triggered unprecedented economic responses around the world. Central banks printed trillions of dollars in stimulus, interest rates dropped to near zero, and inflation fears started rising. Against this backdrop, Bitcoin's fixed supply and decentralized nature looked more appealing than ever. It wasn't just internet money anymore. It was increasingly seen as digital gold, a hedge against traditional money devaluation. Perhaps the biggest moment in this transition came when MicroStrategy, a publicly traded business intelligence company, announced in August 2020 that it had converted a significant portion of its corporate treasury, over $250 million, into Bitcoin. CEO Michael Saylor described Bitcoin as a dependable store of value in a time of monetary chaos. This move was bold, but it started a trend. Soon after, Square, led by Jack Dorsey, and Tesla, under Elon Musk, would follow with their own Bitcoin investments. But MicroStrategy was the first to open that door. In hindsight, 2019 and 2020 were not quiet years at all. They were pivotal. These 2 years laid the foundation for Bitcoin's next bull run by transforming it from a retail-dominated asset into a serious part of institutional portfolios. Infrastructure improved, narratives evolved, and adoption deepened. Not with hype, but with conviction. The Wild West of crypto was still present, but the frontier was beginning to look more like Wall Street, and Bitcoin was no longer the outsider. It was becoming part of the global financial system. Quietly, steadily, the next chapter was being written. And that next chapter brings us to topic number 12. On May 11th, 2020, Bitcoin underwent its third halving event, cutting the block reward from 12.5 to 6.25 BTC. While halving events are part of Bitcoin's built-in monetary schedule, this one hit differently. It occurred during a global monetary crisis, reinforcing Bitcoin's narrative as a hard asset. Supply was tightening while global liquidity was rising. The macroeconomic contrast couldn't have been bigger, and it became one of the key forces behind the next wave of adoption. With the groundwork already laid by previous years of infrastructure building, the network was ready. Exchanges, custody services, and institutional-grade products were mature enough to handle what came next. Demand from traditional finance grew stronger, and Bitcoin found itself positioned not just as a speculative asset, but as a hedge against uncertainty. By early 2021, momentum was impossible to ignore. Bitcoin surged past its previous high, breaking through 20,000, then 30,000, and finally reaching 64,863 on April 14th. This wasn't driven by retail frenzy alone. It was fueled by deeper confidence from a broader base of investors, analysts, and financial institutions. Later that year, the world watched as El Salvador took the bold step of becoming the first country to adopt Bitcoin as legal tender. It was a historic moment that marked Bitcoin's entry into sovereign monetary policy. The experiment came with challenges, including volatility and pushback from international organizations. But the message was clear. Bitcoin had evolved from a software experiment into a geopolitical force. The period between 2020 and 2021 marked a true transformation, not just in price, but in perception. Bitcoin had become something bigger, a tool for financial resilience in a world where central bank actions were becoming increasingly unpredictable. It no longer needed to prove it could survive. It had to prove it could lead. And once again, we must crash in order to rise again. Which brings us to topic 13. After every meteoric rise in Bitcoin's history, there's almost always been a reckoning, a crash, a correction, a moment where the hype collapses and reality sets in. And that's exactly what happened in 2022. Coming off the highs of the previous year, optimism was everywhere. Bitcoin had hit an all-time high, institutions had joined the movement, and even nation-states were testing adoption. But the crypto world still had a dangerous vulnerability: over-reliance on centralized platforms. And in 2022, that flaw would be exposed in the most brutal way possible. It started with the collapse of Terra's Luna and UST ecosystem, a so-called algorithmic stablecoin that promised to maintain its peg to the dollar through code alone. At one point, it was worth tens of billions of dollars. But when confidence cracked, the algorithm failed to hold its value, causing a complete death spiral. The collapse vaporized wealth almost overnight, destroying not only the token's value but also trust in the broader DeFi landscape. That was just the beginning. The fallout spread to other firms that had been heavily exposed. Celsius, a major crypto lending platform, froze withdrawals and declared bankruptcy soon after. Then came Voyager, another crypto brokerage that couldn't withstand the pressure. And the biggest blow of them all came in November 2022, when FTX, one of the most well-known and widely used crypto exchanges, collapsed in spectacular fashion. FTX had been seen as a rising star. Its founder, Sam Bankman-Fried, was featured on magazine covers, spoke at global conferences, and lobbied policymakers. But behind the scenes, the company had allegedly misused customer funds and run a tangled web of risky financial schemes. When the truth began to unravel, users scrambled to withdraw their funds, only to find that billions were missing. In just a matter of days, FTX went from being a global giant to filing for bankruptcy, and Sam Bankman-Fried was arrested soon after. The crypto world was left stunned. Trust in centralized exchanges, which had already taken a hit years earlier with Mt. Gox, was once again shattered. Bitcoin wasn't the cause of any of these failures. In fact, the Bitcoin network continued to run flawlessly, but it was affected nonetheless. The price dropped sharply, falling to around $15,500, its lowest point in over 2 years. Sentiment turned bearish. Headlines declared the end of crypto. Regulators around the world, especially in the United States, seized the moment to push for stricter controls. The industry braced for another long winter. And yet, as always, Bitcoin didn't die. It endured. Those who had been through previous cycles understood the pattern. Excesses get cleared out, the market gets humbled, and slowly, the rebuilding begins. 2022 wasn't just a bear market. It was a purge, a painful but necessary reset. It reminded everyone why Bitcoin's core values, decentralization, transparency, and verifiability matter more than ever. Trust in platforms may falter, but trust in math and open code remained unbroken. After every winter comes a spring, and for Bitcoin, that spring began in 2023. But this wasn't just a recovery in price. It was a renaissance of innovation, regulation, and renewed institutional focus. The trauma of 2022 had left scars, but also clarity. The industry realized that real progress couldn't be built on hype, speculation, or centralized failures. It had to be rooted in transparency, verifiability, and open networks. And as we entered 2023, Bitcoin quietly started climbing back, not just on charts, but in the minds of investors, developers, and regulators alike. One of the most fascinating developments early in 2023 came not from Wall Street, but from the Bitcoin protocol itself, or rather, what people began building on top of it. In January, a developer named Casey Rodarmore launched the Ordinals protocol. It allowed users to inscribe data, including images, art, and even code, directly onto individual Satoshis, the smallest units of Bitcoin. In effect, it gave rise to a form of NFTs on Bitcoin. This was a huge shift in perception. Until now, most believed Bitcoin was purely for money, while Ethereum handled experimentation. But Ordinals opened the door to creativity, culture, and collectibles on Bitcoin's base layer. Some loved it, others hated it. But either way, it proved that Bitcoin wasn't standing still. Later that year, Casey returned with another innovation, Runes. Activated on April 20th, 2024, the exact same day as Bitcoin's fourth halving, Runes introduced a new token standard on Bitcoin. This was significant because, unlike Ethereum's ERC20 tokens, Bitcoin had never been known for supporting meme coins or token ecosystems. Runes changed that. For the first time, Bitcoin became home to its own meme coin mania. Some saw it as a distraction. Others saw it as the beginning of a broader, more flexible Bitcoin ecosystem. But there was no denying it. Bitcoin had started evolving again, not just in ideology, but in functionality. And while all of this was happening, institutions were quietly preparing a different kind of revolution, one based on regulation and legitimacy. After years of rejection, the US Securities and Exchange Commission finally approved spot Bitcoin ETFs in January 2024. 11 of them, BlackRock, Fidelity, ARK Invest, some of the biggest financial names in the world, now had direct exposure to Bitcoin through regulated investment vehicles. This was monumental. It meant pension funds, insurance companies, and conservative investors could now access Bitcoin without touching a wallet, downloading a seed phrase, or learning about block explorers. And that changed everything. The result? Bitcoin surged to a new all-time high, hitting approximately $73,000 in March 2024. But unlike the bull runs of 2013, 2017, or 2021, this one felt different. It wasn't driven by memes or mania. It was driven by macro trends, professional investors, and hard economic reasoning. Bitcoin was no longer just an alternative. It was becoming a serious contender in the global financial landscape. By mid-2024, the network had completed its fourth halving. The block reward was now 3.125 BTC. And yet, despite the lower issuance, miner revenue remained strong thanks to increased on-chain activity from ordinals, runes, and broader adoption. Layer 2 networks like Lightning were expanding quietly in the background, making Bitcoin payments faster and cheaper than ever. Bitcoin wasn't just surviving, it was thriving on every level: protocol, culture, infrastructure, and price. So what was 2023 and 2024 really about? Not just recovery, not just redemption. These were the years Bitcoin began to step into maturity. The cycles of boom and bust had forged resilience. The innovations showed it could evolve, and the institutions proved they could no longer ignore it. Bitcoin had been battle-tested, and it came out sharper, stronger, and more relevant than ever. And we finally arrived to present time and our last topic for today. On the global stage, Bitcoin has entered a new era of political and institutional relevance. More payment processors and fintech companies support it than ever before. In some countries, it's accepted by major retailers and even used for payroll and remittances. Governments are watching closely, some with interest, others with concern. But one thing is clear: Bitcoin is not going away. Spot ETFs have normalized its presence on traditional financial markets. Pension funds are allocating small percentages to it. Central banks, while not adopting it, are at least factoring it into risk models. That alone marks a seismic shift from the early days of being dismissed as magic internet money. And there are tons of strong statements suggesting Bitcoin might become part of federal reserves. And if leading economy, which is US, does it, most likely every other country will follow. And finally, for the people who have been here since the beginning, the ones who mined on laptops, debated block sizes, and held through winters, 2025 is a kind of vindication. Bitcoin has outlasted countless doubters. It has grown up, not by changing its core principles, but by proving their value over time. It's not perfect, it's not finished, but it is alive and more relevant than ever. So, where does Bitcoin go next? No one can say for sure, but one thing is certain: this story is far from over. If the last 17 years have taught us anything, it's that Bitcoin will continue to evolve, continue to surprise, and continue to challenge the way we think about money. And whatever comes next, it will be built on the foundation laid by every single block, mined every 10 minutes since 2009. And with that, we finalized Bitcoin. Now it is time to explore father of smart contracts, which is Ethereum. We will start by diving deep, even before it officially launched. In late 2013, a young programmer named Vitalik Buterin became frustrated with Bitcoin's limitations. While Bitcoin was a revolutionary system for peer-to-peer digital money, it wasn't designed to be flexible or programmable. Vitalik envisioned something different: a blockchain that could run code, allowing developers to build decentralized applications directly onto the network. These applications wouldn't rely on middlemen, could be used by anyone in the world, and would work automatically through something called smart contracts, small programs that execute on their own when certain conditions are met. That vision became the foundation of Ethereum. To bring it to life, Vitalik wrote the original Ethereum white paper in late 2013, which outlined how such a programmable blockchain could work. His idea quickly caught the attention of others in the early crypto space, and soon he was joined by several co-founders who helped shape the project's future. Among them were Mihai Alizi, Anthony D'Iorio, Charles Hoskinson, Joseph Lubin, Gavin Wood, and Amir Chetrit, each bringing different strengths from software development to business strategy. In April 2014, Gavin Wood published the Ethereum Yellow Paper, a more technical document that described the protocol in detail and laid out how the network would actually function under the hood. By that point, Ethereum was more than just an idea. It was becoming a real project. What made Ethereum stand out wasn't just its technology, but its bold ambition to become a kind of world computer where anyone could build tools, services, or organizations that no single company or government could shut down. And that idea might sound similar to something. And if you think about it, it sounds much close to the idea of internet back in the day. Same as Ethereum, internet had revolutionary idea of connecting and upgrading the way world operates. And same as people today don't understand crypto. Back in the day, they thought same about internet, calling it a scam. So ask yourself one simple question. Which person do you want to be? One that closes eyes on something that might change the world, or one that recognizes that and takes advantage of being early? All right, getting back to topic. And this concept was still before the Ethereum blockchain had even launched. This early period, from late 2013 through mid-2014, was about defining the mission, assembling a team, and preparing for the next big step, raising the funds to build it. That step would come soon through something called a crowd sale, but we'll get to that in the next topic. For now, what matters is understanding the origin. Ethereum began with a teenager's frustration, a bold idea for programmable money, and a group of believers who turned that idea into a movement that would reshape the entire crypto space. Whether you're a complete beginner or already curious about blockchain, knowing where Ethereum came from gives you the perfect starting point for understanding where it's going next. And speaking about next, we can move to topic number 2. With the Ethereum white paper published and a team of co-founders assembled, the next step was to make the project real, and that meant funding it. In 2014, the Ethereum team launched something called an initial coin offering, or ICO in short, which was still a brand new concept at the time. Instead of raising money from banks or investors, they opened the door to the public. Anyone could send Bitcoin to the Ethereum Foundation and receive future ETH tokens in return. This was long before Ethereum had even launched, so buyers were supporting nothing more than a vision and a promise. Still, it worked. Over the course of several weeks in mid-2014, the ICO raised over $18 million worth of Bitcoin, a massive success by the standards of that time, and one of the first signs that Ethereum had serious potential. The Ethereum Foundation, a nonprofit based in Switzerland, was created to manage these funds and guide the development of the platform. Its goal was simple: support the creation of an open, decentralized network that anyone could build on, with no corporate ownership or control. After nearly a year of development and testing, that goal took its first real step forward on July 30th, 2015, with the launch of Ethereum's Genesis block. This event marked the official birth of the Ethereum blockchain. The first release was known as Frontier, an early bare-bones version of the network meant mainly for developers and technical users. It wasn't flashy or polished, but it was live, and it worked. For the first time ever, people could deploy smart contracts on a public blockchain, transfer ETH between wallets, and interact with decentralized applications, all without needing permission from any centralized company or authority. It was a quiet but historic moment, the beginning of what would later grow into the foundation of Web3. This early launch proved that Ethereum's technology wasn't just theoretical. It could function in the real world. And while there were still many challenges ahead, including stability issues and limited functionality, the core idea had finally become reality. What's especially important to understand here is how different this approach was compared to traditional tech companies. Ethereum didn't start with a product and then look for users. It started with an idea, programmable money, and let the community shape what it would become. From the very beginning, Ethereum's story was about giving people tools and letting them build. That spirit of experimentation, openness, and global participation would go on to define the entire Ethereum ecosystem. And as we'll see in the next topic, once the network was live, it didn't take long for the first wave of real innovation to begin, including early upgrades, new apps, and the start of Ethereum's massive growth phase. And that early growth is what brings us to topic number 3. After Ethereum's launch in July 2015, the network entered a phase of experimentation and learning. The very first version, called Frontier, was just the beginning, a kind of test bed for developers to explore what was possible with smart contracts and decentralized applications, or dApps in short. As the community grew and feedback came in, the Ethereum team prepared the next big step, the Homestead upgrade. Released in March 2016, Homestead was Ethereum's first major update, bringing increased stability, bug fixes, and improved tools for building on the network. It marked Ethereum's transition from a rough prototype into something more solid and usable. With this upgrade, confidence started to build, and developers from around the world began to take Ethereum seriously. That same year, we saw the birth of some of the first real dApps, decentralized applications that lived entirely on the blockchain. These included early and ambitious projects like Augur, a prediction market that let people bet on future events using ETH, MakerDAO, which laid the groundwork for decentralized stablecoins and borrowing systems, and Golem, a platform that aimed to create a global decentralized marketplace for computing power. Each of these projects showed that Ethereum wasn't just theory, it was a platform for innovation. Anyone from anywhere in the world could now create financial tools, games, marketplaces, or organizations that didn't rely on banks, governments, or tech giants to operate. That was a revolutionary idea. And even in these early days, it was already starting to catch on. Developers were attracted by Ethereum's flexibility. Users were curious about the new kinds of apps being built, and the broader crypto community began to recognize Ethereum as more than just a Bitcoin alternative. It had its own identity, its own purpose, and a growing list of real-world use cases. But as with any new technology, growth came with new challenges. And as we'll soon see in the next topic, one project in particular would push Ethereum to its limits, spark a massive debate, and change the course of its history forever. But for now, just know this. The Homestead upgrade and the first wave of dApps proved that Ethereum was more than just hype. It was working, it was growing, and it was starting to deliver on its bold promises. Then in 2016, some major things occurred, and we will explore them now within topic number 4. In 2016, Ethereum faced its biggest test yet, a crisis that not only shook the network, but also forced its community to make a decision that would define Ethereum's identity forever. It all started with something called the DAO, short for Decentralized Autonomous Organization. Think of the DAO as a kind of venture fund, but without a company, a CEO, or a boardroom. Instead, it was fully run by smart contracts on Ethereum. The idea was simple but powerful. People could send in ETH, and those funds would be used to invest in projects, with the community voting on where the money should go. It was one of the first large-scale use cases for Ethereum, and it captured massive attention. In just a few weeks, the DAO raised over $150 million worth of ETH, an unheard of amount at the time. But then something went wrong. Just a few weeks after the fundraising ended, a hacker found a vulnerability in the DAO's code, not in Ethereum itself, but in how the DAO was written. Using that bug, the attacker began draining funds into a child DAO under their control. By the time the attack was paused, around $60 million worth of ETH had been moved. The Ethereum community was stunned. People began debating, should the blockchain be altered to fix the mistake, or should it stay unchanged to preserve the principle that code is law? After intense discussion, the community chose to take action. A majority supported a hard fork, a change in the Ethereum code that would reverse the hack and return the stolen funds to their original owners. This decision led to the split of Ethereum into 2 separate blockchains. The forked version, which reversed the hack, became what we now know as Ethereum. The original chain, which continued without modification, became Ethereum Classic, supported by those who believed no blockchain history should ever be altered, no matter the reason. This moment was about much more than fixing a bug. It was about trust, governance, and what it means for a blockchain to be truly decentralized. On one hand, the fork showed Ethereum's human side, a willingness to protect its users and respond to emergencies. On the other hand, it opened the door to criticism that Ethereum could be changed if enough people agreed, which some saw as a weakness. But despite the controversy, the hard fork worked. The Ethereum community moved forward, development continued, and confidence returned. In fact, many people see this episode as a sign of Ethereum's strength, the fact that the ecosystem could survive a massive hack, make a tough call, and keep building. And that resilience would become more important than ever as Ethereum faced new challenges ahead. But for now, what you need to understand is this. The DAO showed both the power and the risk of smart contracts. It proved that real money and real decisions could happen on Ethereum, but also that security and governance were just as important as innovation. And in the end, it made Ethereum stronger, more experienced, and more prepared for the road ahead. And that road is exactly what we will explore in our next topic, which is number 5. After surviving the DAO crisis, Ethereum entered a new phase between 2017 and 2019, a period full of explosive growth, but also major growing pains. On one hand, the ecosystem was thriving. This was the time when thousands of new tokens were created, thanks to something called the ERC20 standard, a simple rule set on Ethereum that let anyone launch their own token on top of the Ethereum network. This led to the famous ICO boom in 2017, where startups raised billions of dollars by selling their new tokens to the public, often with nothing more than a white paper and a promise. Ethereum was the engine behind it all, powering this wave of blockchain fundraising that was unlike anything the tech world had ever seen. But while all of this attention was great for adoption, it also exposed Ethereum's weaknesses. One major issue was scalability. With so many people using the network at once, Ethereum began to slow down. In fact, one single application, a collectible game called CryptoKitties, became so popular in late 2017 that it actually clogged the entire network, causing delays and skyrocketing fees. It was a wake-up call. Everyone knew Ethereum had potential, but now it was clear that the current version couldn't handle mainstream traffic. To address this, Ethereum launched a set of planned upgrades known as the Metropolis phase. The first upgrade, called Byzantium, went live in October 2017, bringing security improvements and new features for developers. The second, Constantinople, arrived in February 2019, with more changes aimed at efficiency and future-proofing. These upgrades were important, but they didn't fully solve the core problem. Ethereum was still limited to about 15 transactions per second. For comparison, Visa handles thousands per second. So, while Ethereum was leading in terms of innovation and real-world usage, it was also showing its limits. At the same time, security was becoming a bigger concern. As more money flowed into the Ethereum ecosystem, smart contracts became a bigger target for hackers. Bugs in code led to lost funds, and new kinds of attacks, like flash loan exploits, began to appear. It became clear that writing secure smart contracts wasn't easy, and even small mistakes could cost millions. Still, Ethereum kept pushing forward. The community was learning fast, developers were becoming more experienced, and tools for auditing and testing were improving. What made this period so important was that it taught everyone, from builders to users, that blockchains aren't just about hype. They're infrastructure, and infrastructure needs to scale, secure, and evolve. Ethereum wasn't perfect, but it was the only smart contract platform being tested at this level, in the real world, with real money. And while it didn't have all the answers yet, the lessons learned during these years laid the groundwork for Ethereum's next phase, one that would redefine finance itself. And that's exactly what we'll explore in the next topic, the rise of DeFi, and how Ethereum became the backbone of a new financial system built entirely on code. By the time we reached 2019, Ethereum had survived a major hack, powered a global wave of fundraising, and pushed through critical upgrades. But what came next would take things to a whole new level. This was the era of DeFi, or decentralized finance, a movement that would turn Ethereum from a developer playground into a serious financial powerhouse. Imagine taking all the services you expect from a bank, lending, borrowing, trading, even earning interest, and recreating them entirely with code. No middlemen, no bank branches, just users and smart contracts. That's exactly what happened during this time. Platforms like Compound and Aave allowed people to lend and borrow crypto assets directly through automated smart contracts. Decentralized exchanges like Uniswap let users swap tokens instantly without giving up control to a third party. This also gave birth to yield farming, a way for users to earn returns by putting their crypto to work in these decentralized systems. Suddenly, Ethereum wasn't just a tool for developers anymore. It was becoming a financial system in its own right, open to anyone with an internet connection. Billions of dollars began flowing into these DeFi protocols, and the term TVL, or total value locked, became the new measure of success. This wasn't just a trend, it was a full-blown revolution. And what made it especially powerful was how transparent and permissionless it all was. You didn't need a credit score, a passport, or approval from a bank. You just needed a crypto wallet and some ETH to get started. But with great power came new risks. The rise of DeFi also brought attention to security flaws in smart contracts. Flash loan attacks, where hackers used clever tricks to manipulate protocols and drain funds, started making headlines. Some projects lost millions in minutes because of bugs or poorly written code. These incidents reminded everyone that while DeFi was powerful, it was still very experimental, and security needed to evolve as quickly as the innovation. But overall, this period solidified Ethereum's position as the most important blockchain in the crypto world. While Bitcoin remained the king of digital gold, Ethereum had become the engine of crypto's new economy. Developers were flocking to it, users were relying on it, investors were paying attention, and most importantly, it was proving that the dream of decentralized finance wasn't just theoretical. It was working, right now, in the real world. This wasn't just about Ethereum anymore. It was about changing the way finance itself operates, removing gatekeepers, building new tools, and creating a system where anyone, anywhere, could participate. And this explosive growth would soon lead to even more attention, especially with the rise of NFTs and the long-awaited transition to Ethereum 2.0. But before we get there, it's important to understand that DeFi wasn't just a feature of Ethereum. It was a turning point. It showed the world that blockchains weren't just about tokens or speculation. They were platforms that could run real economies. And Ethereum, more than any other network, was proving itself as the foundation for that future. It was time for major things. And those major things bring us to topic number 7. By the time Ethereum reached the end of 2020, it was clear that something big had to change. The DeFi boom proved how powerful Ethereum could be, but it also exposed its biggest weakness. The network simply couldn't scale fast enough. Fees were rising, congestion was constant, and Ethereum's old infrastructure, built on proof of work just like Bitcoin, was starting to show its age. That's why developers had already been working behind the scenes on something massive, Ethereum 2.0. This wasn't just a small upgrade. It was a full transformation of how the entire network worked. The first major step came in December 2020, with the launch of the Beacon chain. This new chain didn't replace Ethereum immediately. Instead, it ran in parallel and introduced a brand new system called Proof of Stake. Unlike Proof of Work, which relies on energy-hungry mining, Proof of Stake allows people to secure the network by locking up ETH and acting as validators. It's cleaner, more energy efficient, and designed to scale better. But Ethereum 2.0 wasn't just about saving electricity. It was about laying the groundwork for the future. Then in August 2021, Ethereum introduced another major upgrade called EIP 1559. This changed how transaction fees worked by introducing something called base fee burning. In simple terms, part of the fees that users pay would now be permanently destroyed or burned, which started to reduce the total supply of ETH over time. That's a big deal because it made ETH potentially deflationary, meaning it could become more scarce and valuable the more it's used. Around this same time, Ethereum was exploding in popularity thanks to NFTs. Unique digital items like CryptoPunks and Bored Apes started grabbing attention, and most of them were built right on Ethereum. Artists, creators, and collectors suddenly had a brand new platform for digital ownership, and Ethereum was the center of it all. These moments weren't isolated. They were signs that Ethereum was evolving far beyond its original vision. It was no longer just a platform for developers or a home for DeFi. It had become a cultural and financial hub, but the most important changes were still ahead. Ethereum 2.0 was never meant to happen all at once. It was being rolled out in phases, each one carefully designed to upgrade different parts of the network. And while the Beacon chain and fee burning were major achievements, the biggest milestone, the actual merge of Ethereum's two chains into one unified proof-of-stake system, was still on the horizon. But even before that happened, it was clear that Ethereum was stepping into its next era. The foundation had been laid, the code was evolving, and the community was preparing for what many believed would be the most important upgrade in crypto history. So while Ethereum still had its challenges, from gas fees to competition from other blockchains, it was proving one thing above all. It could adapt, it could grow, and it could lead. And that leadership would soon be tested as Ethereum prepared for the event known simply as the merge, the moment when Ethereum would finally leave proof of work behind for good. And right now in topic number 8, we will explain that merge period. And now we've arrived at one of the biggest events in Ethereum's entire history, the merge. After years of development, testing, and anticipation, Ethereum officially transitioned from proof of work to proof of stake on September 15th, 2022. This wasn't just a software update. It was a complete shift in how Ethereum operated under the hood. Before the merge, Ethereum still relied on mining, just like Bitcoin, where computers competed to solve puzzles and validate transactions. But mining is energy intensive and not sustainable long term. So, Ethereum replaced that system with something called proof of stake, where people stake their ETH to help secure the network and earn rewards for doing so. What's amazing is that this shift happened while Ethereum was still running. There was no pause, no restart, and nothing shut down. It all happened live through a carefully coordinated upgrade that joined the original Ethereum mainnet with the new Beacon chain running in parallel since 2020. The result? Ethereum immediately cut its energy usage by more than 99.9%. That's not a small improvement. It's like replacing an entire power plant with a light bulb. The merge proved that massive systems can evolve without breaking, and that a global, decentralized network can make bold moves if the community believes in it. But the merge wasn't just about saving electricity. It also laid the final piece of groundwork for Ethereum's future, a future built on scalability, sustainability, and economic efficiency. By moving to proof of stake, Ethereum opened the door to faster upgrades, stronger security models, and better integration with Layer 2 solutions that help the network handle more traffic. And remember the fee-burning upgrade we mentioned earlier? Combined with staking, this change made Ethereum's economy much healthier. Some even argue that ETH could eventually become a fully deflationary asset. But for the average user, here's what truly matters. Ethereum now runs cleaner, more efficiently, and is more adaptable than ever before. And it did all of this without ever going offline. That's the power of open source development and global coordination. The merge showed that Ethereum wasn't just built to survive. It was built to grow, adapt, and lead. And as we move forward into 2023 and beyond, this upgrade will serve as the backbone for everything else coming next, including scaling solutions, faster transactions, and unlocking the full potential of Web3. So if you're just getting into crypto and wondering why Ethereum matters, this is why. Because Ethereum just pulled off one of the most complex upgrades in tech history, while never losing sight of its core mission, to build an open, decentralized future that anyone can be part of. But one thing was considered troublesome with this upgrade, and that is the fact that in order to run a node on proof-of-stake consensus mechanism, you need to stake at least 32 ETH, which by current prices far exceeds 50,000 US dollars. And that amount is not small for general public and average person. And that raised a question of decentralization. The core idea of crypto is to be open for everyone, but we must agree that amount needed to run a node far exceeds the budget of average user. But very short after the merge, staking pools were founded. The idea was to enable anyone to join a pool with smaller amount of ETH and make total sum of all pool exceed the 32 requested amount. This concept gave everyone a chance to participate, regardless of the amount they are able to stake. Merge was done, but upgrades never stopped. In fact, they intensified, which we will now discuss in topic number 9. And that brings us to the phase known as post-merge upgrades, which began in 2023 and continued into 2024. While the merge was a major milestone, it didn't immediately make Ethereum faster or cheaper to use. That's where the next wave of changes came in. The first big upgrade was called Shanghai, or sometimes Chapella, and it launched in April 2023. This upgrade finally allowed validators, the people staking their ETH to help run the network, to withdraw their staked ETH and rewards. Up until that point, anyone who staked ETH had to keep it locked. So this upgrade was a major moment of trust and maturity, showing that Ethereum's proof-of-stake model was now complete. But the real buzz in 2024 came from a different kind of upgrade called proto-danksharding, also known as EIP 4844. That might sound super technical, but here's what it means in simple terms. Proto-danksharding is a stepping stone to something bigger called full danksharding, which is Ethereum's long-term scaling strategy. It helps Layer 2 solutions, like Optimism, Arbitrum, and zk-Sync, become way more efficient by giving them cheaper space to store data on Ethereum. This is huge, because instead of trying to cram everything into one lane, Ethereum is now building highways for Layer 2s to operate on top. These rollups process transactions off-chain, but settle them on Ethereum, combining speed with security. And with Proto-danksharding live, rollups can now offer lower fees and faster speeds to users, bringing Ethereum one step closer to being ready for mainstream adoption. These improvements might not be as dramatic as the merge, but they're critical. If Ethereum wants to support millions of users and global scale applications, it has to be affordable and fast. And instead of trying to do everything on its own, Ethereum is now evolving into what many call a modular blockchain, meaning it handles the core security and data availability, while rollups and other tools handle the user-facing activity. This structure allows Ethereum to remain decentralized and secure, while still offering performance that can compete with faster chains. So if you've ever tried to use Ethereum and thought, why are the fees so high? Or why is this so slow? The upgrades in 2023 and 2024 were designed to directly solve those problems, not by patching over them, but by rebuilding the system in a smarter way. These changes also reflect a broader philosophy shift. Ethereum isn't trying to be one giant machine anymore. It's becoming a flexible platform that supports an ecosystem of tools, apps, and extensions, all while keeping the base layer neutral, secure, and minimal. And as we look ahead to the next and final phase of Ethereum's long-term roadmap, full dank sharding, and statelessness. These post-merge upgrades represent a critical bridge between the Ethereum of the past and the Ethereum of the future, a future where anyone, anywhere, can use blockchain tech without needing to understand the tech at all, just like using the internet today. But before we get there, let's take a look at where Ethereum stands right now, in 2025, and what's next on its roadmap, because the story isn't over. It's just getting started. All right, time for present, and also our final topic for today. What began as a bold idea more than a decade ago has evolved into the backbone of the decentralized internet. Ethereum today is no longer just the smart contract platform. It's the foundation for thousands of applications, roll-ups, and protocols that handle everything from finance to identity to gaming. Thanks to upgrades like Dencun and Proto-Dank sharding, Ethereum has embraced a modular architecture where the base layer focuses on security and data availability, while faster Layer 2 solutions like Optimism, Arbitrum, and Zcasing handle most of the actual user activity. This shift has made transactions cheaper and faster, helping Ethereum scale without compromising decentralization. More importantly, it's paved the way for what comes next: full dank sharding and stateless clients, major milestones that will allow Ethereum to handle massive global usage without bloating the network. Meanwhile, Ethereum continues to dominate in real-world use. Billions are locked in decentralized finance, DeFi protocols. Real-world assets like real estate and bonds are being tokenized on-chain, and NFTs still power everything from digital art to in-game collectibles. Institutional adoption has also grown, not always in headlines, but in infrastructure, with financial giants and governments exploring Ethereum as the settlement layer of the future. At the same time, Ethereum has become more interconnected. Bridges and cross-chain protocols now allow assets to move freely between Ethereum and ecosystems like Solana or Cosmos, making Ethereum a central hub in the broader Web3 world. Of course, challenges remain. User experience, UX, still needs to improve for mainstream adoption. Wallets, onboarding, and recovery are better, but not seamless yet. And debates about governance, upgrade paths, and funding models are becoming more complex as Ethereum grows. But despite these hurdles, Ethereum has proved its staying power. It's no longer a speculative experiment. It's infrastructure. It's the rails for decentralized apps, money, and digital ownership. In 2025, Ethereum isn't just a platform. It's a movement that's still growing, still evolving, and still guided by the original mission: to build an open, permissionless future that anyone in the world can access. And the best part? The most important chapters of Ethereum's story may still be ahead. All right, we finished 3 more to go. And next one is Ripple XRP. What if I told you that idea behind Ripple originates all the way to 2004, long before even Bitcoin existed? Would you believe me? Let's find out. Many people know that Ripple, which is the company behind XRP, was founded in 2012. But what if I told you that Ripple's history dates back all the way to 2004, even before Bitcoin was created? Would you believe me? Let's find out. Back in 2004, long before the idea of Bitcoin even existed, a web developer named Ryan Fugger was working on a concept in Vancouver, Canada. His goal wasn't to create a global cryptocurrency. Instead, he wanted to build a system that allowed people to create their own credit and exchange value within their local communities. This project became known as Ripple Pay. It was a peer-to-peer payment platform that let people send assets to one another and track balances, like a shared ledger between trusted friends or neighbors. Now, keep in mind, this was way before blockchains became a thing. There was no mining, no tokens, and definitely no XRP. But what made Ripple Pay important was the idea behind it. It introduced the concept of a decentralized network for exchanging value, not relying on banks or big financial institutions, but on direct relationships. That idea, even though simple, planted the first seed of what would later evolve into the XRP ledger. This original version of Ripple was small and local, but it carried a big vision. And that vision attracted the attention of people who were thinking about building something bigger, something faster, something that could compete with Bitcoin itself. And that's exactly where we're heading next. Now that we know the founding idea, it is time to skip to 2011 and explore a period where XRP we know today was born. While Ripple Pay quietly existed as a small experimental platform, a new wave of cryptographic minds began thinking about how to solve some of Bitcoin's biggest limitations. Among them were David Schwartz, Jed McCaleb, and Arthur Brito. These 3 engineers had a different vision. They saw potential in blockchain technology, But they also saw flaws in Bitcoin's design, like its slow transaction speeds and heavy reliance on mining, which consumes enormous amounts of energy. They believed they could build something better. Instead of copying Bitcoin, they designed their own ledger from scratch. It would still use cryptography and decentralized consensus, but without the need for mining or proof of work. Their goal was to create a faster, more scalable, and energy-efficient digital asset. This new system would become the XRP Ledger, and it officially launched on June 2nd, 2012. From the start, the XRP Ledger was designed for speed and efficiency. Transactions could settle in just seconds, and the system could handle much higher traffic than Bitcoin or Ethereum at the time. But perhaps the most important part of this launch was the creation of its native digital currency, XRP. Unlike Bitcoin, which is mined over time, all 100 billion XRP tokens were created in one shot, or what's called pre-mined. Out of those 100 billion tokens, 20 billion were distributed among the three creators. The remaining 80 billion were handed over to a new company that would be formed shortly afterward, a company that would carry this technology to the world stage. But even at this early moment, there was controversy. Some in the crypto world were uncomfortable with so much XRP being held by founders and one central entity. Still, the XRP ledger was live, functional, and incredibly advanced compared to its peers. This was no longer a community IOU network. It was now a fully operational blockchain designed for enterprise-level use. And while it may have started quietly, the XRP ledger was about to become one of the most talked-about platforms in crypto history. Before we move on, if you like the value you're getting, please consider subscribing. At Bitcoin Academy, we try our best to bring complete beginners to a world of cryptocurrencies. We don't do price predictions and hyped trending videos. We only focus on education, and hopefully you see it. All right, getting back to video. After the XRP ledger was successfully launched, the next logical step was to build a company around it. And that's exactly what happened in 2012 when OpenCoin was founded. This company would later be rebranded to the name we all know today, Ripple Labs. It was co-founded by Chris Larsen and Jed McCaleb, two individuals who played major roles in shaping the company's early direction. Chris Larsen came from a background in finance and fintech, while McCaleb was already known for his role in creating the file-sharing platform eDonkey, and later the crypto exchange Mt. Gox. The goal of Ripple Labs was very different from the rest of the crypto space at the time. While Bitcoin was focusing on decentralization and avoiding banks altogether, Ripple took the opposite route. They wanted to work with financial institutions. Their mission was to modernize and improve the infrastructure that global payments depend on, especially cross-border transactions, which are notoriously slow and expensive. And instead of replacing the system, Ripple aimed to upgrade it from the inside out, using the speed and efficiency of the XRP ledger. One of Ripple's early strategic decisions was to hold the majority of XRP supply. As we mentioned earlier, 80 billion XRP tokens were handed over to the company after the ledger was launched. This reserve would later become a powerful tool, giving Ripple the ability to fund development, attract partners, and grow its ecosystem. Of course, this also brought heavy criticism from those who believed that such large holdings gave the company too much influence over a supposedly decentralized cryptocurrency. Still, Ripple Labs got to work fast. With the XRP ledger as its foundation and XRP as its native asset, the company began building products aimed at solving real-world financial problems. Their first target was the outdated messaging systems used by banks for international transfers called SWIFT. The same systems that rely on intermediaries and often take days to process payments. Ripple wanted to replace this with instant, low-cost settlement powered by XRP. By the end of 2012, Ripple Labs had already established itself as a serious player in the blockchain world. It wasn't chasing hype or speculative trading. It was building infrastructure, real tools for real banks with real use cases. And that's something very few crypto companies were focused on back then. This enterprise-level focus would later define Ripple's identity in the crypto space and set the stage for both its biggest wins and its biggest controversies. But this great environment would face problems really soon. And that brings us to topic number 4. In 2013, just a year after Ripple Labs was founded, the company found itself at a crossroads. It had promising technology, a growing team, and ambitious goals. But internal tensions began to rise. One of the earliest challenges came from within, as differences in vision among the co-founders started to surface. Jed McCaleb, one of the original minds behind the XRP ledger, began to clash with the direction the company was taking. He had a more open source, decentralized philosophy, while others, like Chris Larson, were focused on building an enterprise-ready infrastructure that could partner with big banks. These disagreements weren't just philosophical. They touched on fundamental questions about how much control Ripple should have over the XRP supply, how fast to grow, and what kind of partnerships to pursue. Eventually, in 2013, McCaleb made the decision to leave the company. But before walking away, he signed a legal agreement that would shape the XRP market for years to come. The deal limited how much XRP he could sell over time in order to prevent market disruption. These controlled sales became a point of controversy in the years that followed, as McCaleb's holdings were substantial. Shortly after his departure, McCaleb went on to launch a new project, Stellar, or XLM, which shared some similarities with Ripple, but emphasized decentralization and open access. It was a clear sign that the philosophical divide between the two approaches to crypto wasn't going away anytime soon. Meanwhile, back at Ripple, the company was raising its first round of funding. Investors saw potential in Ripple's approach to improving cross-border payments, and early capital gave the company resources to expand its team and start building out its suite of products. But even with investor confidence, the company now had to deal with growing public skepticism. Some in the crypto community saw Ripple's large XRP holdings and leadership structure as too centralized for a truly trustless ecosystem. Still, Ripple pressed forward. Despite the drama, despite the doubts, the technology was solid and the mission was clear. By the end of 2013, Ripple had raised millions, survived its first internal shakeup, and started to separate itself from the pack as a blockchain company focused on real-world utility, not just speculation. It was a turbulent chapter, but also a defining one. The exit of a co-founder, the birth of a rival project, and the first major funding round all helped forge Ripple's path forward. What came next was an intense period of product development, partnerships, and slow but steady growth. And that exactly brings us to topic number 5. After weathering the internal turbulence of 2013, Ripple entered a critical phase between 2014 and 2016. These years didn't generate headlines the way price spikes or lawsuits would later, but they laid the foundation for Ripple's future success. This was the development era, an era when bold ideas turned into working products and new financial partnerships started to quietly reshape how money could move globally. Ripple's team focused heavily on building actual infrastructure. Rather than getting caught up in the speculation that was starting to surround other cryptocurrencies, they doubled down on utility. Their early product roadmap began to take shape with 3 core offerings: Xcurrent, Xrapid, and Xvia. These tools weren't just buzzwords. They were designed to address real-world pain points that banks and remittance providers struggled with every day. Things like slow settlement, high transaction costs, and lack of interoperability across systems. Xcurrent allowed banks to communicate and confirm payment details in real time. It didn't require XRP, but it built the foundation of trust and messaging that made cross-border transfers more efficient. Then came Xrapid, which did use XRP as a bridge currency to settle transactions instantly with minimal cost. Finally, Xvia aimed to connect various payment networks, allowing businesses to plug into RippleNet easily and send money globally without needing separate integrations for each destination. But products are only as useful as the partners who use them. And this is where Ripple started gaining momentum. During this phase, Ripple signed deals with a handful of early adopter institutions. Banks like Fidor in Germany, Cross River in the United States, and financial service companies like Earthport began testing or implementing Ripple's technology. These weren't just experiments. They were real signs that Ripple's approach could find a home in the traditional financial system. These early partnerships helped Ripple build credibility. It wasn't just a crypto startup anymore. It was a financial technology company actively working with banks to improve settlement infrastructure. This was important because in a space often dominated by hype and short-term gains, Ripple was proving that long-term strategy mattered. By the time 2016 rolled around, Ripple had positioned itself as one of the few blockchain companies with live products, real clients, and a growing network. XRP still wasn't widely used, but the rails were being laid. The next time the crypto market exploded, Ripple would be ready, not just with a vision, but with a working system that had already been years in the making. And that boom would happen sooner than anyone expected. Which brings us to topic number 6. As 2017 began, the cryptocurrency world was starting to catch fire, and Ripple was in a perfect position to take advantage of it. Years of quiet development, strategic partnerships, and infrastructure building were about to pay off. While many coins surged during this period due to hype alone, XRP's rise came with real momentum behind it. Ripple's business model was maturing, and its technology was being tested in live financial environments. This wasn't just a lucky pump. This was years of planning coming into focus at just the right time. At the core of Ripple's surge was RippleNet, a network of banks and financial institutions that could communicate and settle payments using Ripple's suite of products. By early 2017, dozens of pilot programs were underway. Banks and remittance providers were no longer just kicking the tires. They were running tests, executing transactions, and proving that Ripple's technology worked in the real world. And as more institutions joined, confidence in Ripple's long-term potential grew. But what truly captured the public's attention was XRP. At the start of 2017, it was trading for less than a penny. Within months, that changed dramatically. As the broader crypto market soared, XRP followed, reaching a peak of $3.84 by early January 2018. It was one of the most explosive price moves in crypto history, and it catapulted XRP into the spotlight. For a brief moment, XRP overtook Ethereum in market cap, making it the second largest cryptocurrency in the world, right behind Bitcoin. No other coin besides XRP has ever done that. See, I told you this wasn't a clickbait, and I believe it deserves a like. Getting back to topic, while much of the crypto world was chasing promises and white papers, Ripple stood out for offering something more concrete. The company wasn't just promoting ideas, it had real clients, running real pilots, using real infrastructure. That distinction earned it attention from both investors and the financial sector. But the rise wasn't without its critics. Some people questioned the connection between Ripple Company and XRP, the asset. After all, Ripple could sell software to banks without requiring them to use XRP. So the question emerged, was XRP's price justified by utility, or was it just riding the wave of speculation like everything else in the bull market? Despite these concerns, the results were undeniable. By the end of 2017, Ripple had positioned itself as a major player, not just in the crypto world, but in the global conversation about the future of finance. It had working products, high-profile partners, and one of the most valuable digital assets on the market. This meteoric rise brought new opportunities, but it also brought new scrutiny. And as the dust settled from the crypto boom, Ripple found itself facing a much tougher environment in the years ahead. 2018 was the year that forced Ripple and XRP to prove whether they could survive outside the excitement of a bull market. After reaching a historic peak, the price of XRP began to fall sharply, not because the project failed, but because the entire crypto market was correcting. This was the moment when hype alone no longer carried value. Every blockchain project suddenly faced the same brutal question. Do they have real-world staying power? For Ripple, the answer was to keep building. While the price of XRP dropped along with the broader market, Ripple continued expanding its international footprint. Instead of chasing headlines, the company focused on growth behind the scenes. One of the key developments was the official launch of XRapid, a liquidity solution that used XRP to bridge currencies in real-time cross-border payments. XRapid had been in testing for years, but in 2018, it began moving into commercial use. This was a big deal because it brought utility to XRP itself. Ripple wasn't just offering blockchain software. It was building a product that relied on the token to deliver speed and cost savings. For all the skepticism about XRP's purpose, this was clear progress toward integrating it into real financial workflows. But that didn't mean everyone was on board. Criticism began to intensify. One of the biggest concerns was Ripple's massive XRP holdings. With billions of tokens held in escrow and released on a monthly basis, some in the crypto community believed Ripple had too much control over the token's supply. That control, they argued, made XRP less decentralized than it should be. Others pointed to the fact that banks using RippleNet weren't necessarily using XRP, which raised questions about the long-term demand for the asset. Despite the noise, Ripple continued signing deals. It opened new offices in regions like the Middle East and Asia, secured high-profile partnerships, and kept onboarding clients to RippleNet. This global expansion helped the company maintain relevance even as many crypto projects faded into obscurity during the bear market. By the end of 2018, XRP remained one of the top cryptocurrencies by market cap. It had lost much of its price momentum, but its underlying business was growing. Ripple's focus on enterprise use and real-world utility had helped it weather the storm, even if trust in its decentralization and long-term model continued to be debated. This year marked a turning point. The hype of 2017 was gone, but Ripple was still standing. And let me congratulate you for making it past half of today's video and encourage you to stay until the end. Knowledge is something that gives you complete edge over others in world of cryptocurrencies. And once again, let me say that by staying until the end, you will know more than 99% of people. All right, without wasting any more time, let's dive into topic number 8. 2019 began with cautious optimism. The crypto winter had cooled off speculation. But for Ripple, the groundwork laid in previous years was beginning to show results. One of the biggest developments at the start of this phase was how Ripple chose to manage its XRP supply. With so many concerns about centralization, Ripple made a move to build trust by locking up 55 billion XRP in escrow. This wasn't a one-time decision. The company implemented a system where 1 billion tokens would be released each month, ensuring a predictable and transparent schedule. The idea was simple: limit market surprises and assure partners that XRP supply wouldn't suddenly flood the market. But that wasn't the only significant move. Ripple's global partnerships began expanding fast. The company was now active in Latin America, the Middle East, North Africa, and Asia Pacific, regions where cross-border payments face enormous friction and high fees. One of the most talked about deals came when Ripple teamed up with MoneyGram, a major player in the remittance space. The partnership used XRP for liquidity via what was then known as XRapid, later rebranded as On-Demand Liquidity, or ODL. This was a major win for Ripple's strategy. Instead of just pitching ideas, it was onboarding major financial institutions to use XRP in live environments. ODL allowed MoneyGram to eliminate the need for pre-funded accounts in destination countries. Instead of parking capital in foreign banks, XRP could be used to instantly source local currencies. That's the kind of efficiency Ripple had been promising for years, and now it was happening at scale. It wasn't just talk anymore, it was operational. Despite the progress, 2020 would prove to be a complicated year. The crypto market began recovering, and interest in blockchain surged again. Ripple's reputation as one of the most established players gave it momentum. But behind the scenes, regulatory uncertainty in the US was becoming a growing threat. Ripple continued to operate in a legal gray zone, especially around the question of whether XRP was a security. The company pushed for clearer rules, but government agencies gave little guidance. Still, business development didn't slow down. RippleNet kept growing, and ODL transactions saw a noticeable rise in volume. New corridors opened up in the Philippines, Mexico, and other emerging markets. Ripple also made strategic investments in blockchain startups and payment platforms to expand its ecosystem even further. The focus was clearly global, where regulation was more favorable, and blockchain adoption was accelerating. However, just as things seemed to be stabilizing, the end of 2020 would bring one of the biggest storms Ripple had ever faced. And that brings us to our next topic, December 2020. Just days before the year ended, Ripple was hit with a lawsuit that would shake the entire crypto world, not just because of what was alleged, but because of who was making the allegation. The U.S. Securities and Exchange Commission, or SEC, filed a formal complaint against Ripple Labs, its CEO Brad Garlinghouse, and co-founder Chris Larsen. The charge? That Ripple had conducted an unregistered securities offering by selling XRP. This wasn't some random accusation. The SEC argued that XRP, the very asset Ripple had been building its business around for years, was in fact a security, and that Ripple sales of XRP, going all the way back to its early days, were in violation of federal law. According to the SEC, Ripple had raised over $1.3 billion through these sales without registering the token as a security or seeking an exemption. The impact was immediate. Within hours, XRP's price dropped sharply, falling below 20 cents. And that was just the beginning. US-based exchanges started reacting quickly. Coinbase, Kraken, Bitstamp, and many others suspended or fully delisted XRP trading, especially for US customers. The asset that had once reached the number 2 spot in global crypto rankings was suddenly at risk of vanishing from American markets altogether. But this wasn't just a hit to the token. It was a direct threat to Ripple's entire business model. Everything Ripple had built over the years, from its financial infrastructure to global partnerships, now faced legal uncertainty. If XRP was ruled a security, the implications would rise far beyond this one case. It could set a precedent affecting how other digital assets are classified and regulated across the board. Ripple, of course, denied the allegations. The company argued that XRP was not a security and that it had always operated transparently. Brad Garlinghouse publicly stated that the lawsuit was misguided and that Ripple would fight it in court. And fight it they did. In the months that followed, the legal battle escalated. Both sides filed motions, released documents, and prepared for what would become the most closely watched court case in crypto history. At stake wasn't just Ripple's future, but potentially the regulatory framework for the entire crypto industry in the United States. Meanwhile, Ripple's international operations kept running. In fact, as US exchanges pulled back, many global partners continued using RippleNet and ODL. Ripple leaned even harder into overseas markets, arguing that the lawsuit highlighted the need for the US to catch up on clear crypto regulation. But the damage was already done. XRP's public image had taken a massive blow. Its availability had been restricted. Its legitimacy was now under intense legal scrutiny. What had once been a rising star was now fighting for survival, not in the markets, but in the courtroom. And yet, this wasn't the end of XRP's story. In fact, what came next would surprise everyone. So let's dive straight into topic number 10. The year is 2021. Just months after being blindsided by the SEC lawsuit, many expected Ripple to lay low, retreat, or even collapse under the weight of legal pressure. But that's not what happened. Instead, Ripple did something unexpected. It pivoted hard. Rather than staying bogged down by the regulatory fight in the US, the company looked outward and doubled down on its global strategy. And that move changed everything. With much of the US crypto industry paralyzed by regulatory uncertainty, Ripple decided to take its technology where it was wanted. International markets became the new battleground, and Ripple was ready. The company ramped up its expansion of on-demand liquidity, the very product that uses XRP to settle cross-border payments across new corridors. Countries like the Philippines, Mexico, and the UAE saw major growth as local partners embraced RippleNet and the speed of XRP-based settlement. This wasn't just about survival. It was about proving that Ripple's technology could still lead, even if the US was on pause. Financial institutions in these regions were more focused on results than regulation, and Ripple was delivering results. Faster payments, lower costs, and a streamlined experience that legacy banking systems simply couldn't match. But perhaps the most interesting development in this period came from an entirely different angle: central banks. As governments around the world began exploring central bank digital currencies, or CBDCs, Ripple stepped up and offered its infrastructure as a foundation. In 2021, Ripple launched pilot programs with two sovereign entities, the Royal Monetary Authority of Bhutan and the Republic of Palau. In Bhutan's case, Ripple partnered with the central bank to explore how the XRP ledger could support a digital ngultrum, which is the name of Bhutan's local currency, with the goal of promoting financial inclusion and faster payments. Meanwhile, in Palau, the focus was on developing a USD-backed digital currency, again leveraging Ripple's tech, but without relying on XRP directly. Back in the US, the legal fight dragged on, but globally, Ripple was rewriting the rules. By focusing on regions that welcomed blockchain innovation, the company not only survived, it grew. The number of corridors using ODL expanded, transaction volumes increased, RippleNet connected more institutions, and XRP remained at the heart of this growing infrastructure. By the end of 2022, Ripple had made one thing clear: it didn't need US regulatory clarity to move forward. While others waited, Ripple built, and in doing so, it kept XRP alive, relevant, and operational. Not because of hype, but because of real-world utility. That's what made this chapter so important. It proved that even under fire, Ripple could adapt, evolve, and win on a global scale. And talking about winning, we came to topic 11, July 13th, 2023, a day that would go down as one of the most important moments in XRP's history, not just because of what was decided, but because of what it finally made clear. After nearly 3 years of legal uncertainty, U.S. District Judge Annalisa Torres delivered a landmark ruling in the Ripple versus SEC case, and the crypto world stopped to listen. The verdict? XRP is not a security, at least not when sold on public exchanges. This was a massive shift. For the first time, a U.S. federal court had drawn a line between how a digital asset is sold and whether or not it counts as a security under American law. The court ruled that programmatic sales of XRP, meaning when it's bought and sold by everyday users on public crypto platforms, did not violate securities laws. That was a clear victory for Ripple, and it sent shockwaves across the industry. You need to understand that there is only a handful of companies that survived a lawsuit from SEC, and even less that actually won it. But the ruling wasn't absolute. Judge Torres also found that XRP can be considered a security when sold directly to institutional investors under certain conditions. So the result wasn't a clean win across the board, but it was enough to restore momentum to Ripple, and more importantly, confidence in XRP's future. And the market responded immediately. Within hours of the decision, XRP's price exploded, jumping more than 70% in a single day. That's not just a rebound, that's a statement. As exchanges that had once distanced themselves from the token started reversing course. Coinbase, Kraken, Bitstamp, and others relisted XRP, signaling that regulatory risk, at least for retail, had drastically diminished. But this moment was about more than just price or listings. It was about vindication. For years, Ripple had argued that XRP was not a security and that the SEC's case was overreach. This ruling validated much of that stance and gave the crypto industry a new legal precedent to work with. It was the first real clarity from a US court on how digital assets could be classified based on their context, something that projects and investors had been begging regulators to define for years. With the legal cloud starting to clear, Ripple shifted gears again. The company ramped up engagement with financial institutions, regulators, and developers. It used this legal momentum to reestablish XRP's credibility and accelerate adoption of its technologies. At the same time, global conversations about crypto regulation began referencing the Ripple case as a turning point, proof that courts could be more effective than regulatory agencies at creating reasonable, nuanced frameworks. By the end of 2023, XRP was back in the spotlight, not just as a digital asset with utility, but as a symbol of crypto's maturing legal landscape. It had weathered the toughest regulatory storm the industry had seen and came out the other side stronger, more defined, and more battle-tested than ever. This wasn't just a partial victory. It was the start of a new chapter, one where XRP was no longer the token under fire, but the one that helped draw the battle lines for the future of crypto in the United States. It was time for clear evolution path. And that brings us to topic 12. As the legal dust began to settle, Ripple didn't waste a moment. By late 2023 and into 2024, the company shifted full speed into growth and innovation. The XRP Ledger, once at the center of the SEC's legal battle, was now back in focus for all the right reasons. And what unfolded was a clear transformation, not just of Ripple's business model, but of the XRP ecosystem itself. This chapter wasn't about defending the past. It was about shaping the future. One of the first major advancements came with the XRP Ledger's support for native NFTs. After years of watching Ethereum dominate the NFT space, despite its high fees and slow speeds, developers on the XRPL began rolling out functionality that allowed users to mint, trade, and interact with NFTs directly on the ledger. No smart contract workarounds, no external dependencies, just fast, efficient, native NFT capabilities baked into the core protocol. This was a significant move, not just technically, but symbolically. It proved that XRP wasn't stuck in its payments-only box. It could evolve and compete in emerging sectors like digital ownership, art, and tokenized assets. But it didn't stop there. The XRP Ledger also introduced sidechain support. This allowed developers to experiment with new features, applications, and use cases, all without compromising the main network's performance or security. Think of it like adding extra lanes to a highway without disrupting the traffic flow. These sidechains enabled use cases ranging from DeFi applications to regulated asset issuance, giving the XRPL a flexibility it never had before. And then came hooks, lightweight smart contract-like functions being developed for the XRP Ledger. This was perhaps the most anticipated innovation. While not as complex as Ethereum's smart contracts, hooks allowed developers to add logic directly to XRPL accounts, opening the door to automated payments, on-ledger voting, and countless other use cases. In other words, the XRP Ledger wasn't just evolving, it was becoming programmable. These upgrades didn't happen in a vacuum. Behind the scenes, Ripple was pushing adoption harder than ever. By early 2024, its on-demand liquidity, or ODL, was being used across more than 40 global corridors. That means real payments, moving in real time across dozens of countries, powered by XRP. At the same time, Ripple expanded its grant programs and developer outreach. The XRPL Grants Initiative, along with partnerships in the DeFi and NFT sectors, helped grow a thriving community of builders. Independent developers, startups, and even financial institutions were now engaging with the XRP Ledger, not just because of Ripple, but because of what the technology itself could do. And we finally made it to present time. In topic 13, we will explore where XRP stands today. Let's break it down. One of the biggest shifts currently on the horizon is Ripple's potential IPO. That's right, Ripple, the company behind XRP's development and ecosystem, has been preparing for a public offering. While the final green light still depends on remaining regulatory clarity in the US, industry insiders and Ripple execs have hinted at serious intentions. If this IPO happens, it would be a massive move, not just for Ripple, but for the crypto industry as a whole. Going public would signal a level of transparency, accountability, and regulatory cooperation that few crypto companies have ever reached. It would bring Ripple into the world of traditional finance in a way that even Bitcoin never could. And it would give institutional investors, including Wall Street, direct exposure to one of the most influential crypto infrastructure companies on the planet. But even with that exciting possibility, there's a major hurdle that hasn't gone away: regulatory clarity in the US. Despite Ripple's partial victory in court, the overall environment for crypto regulation remains murky. Laws are outdated, and agencies still clash over who gets to define what. That's why Ripple continues to push hard for more consistent, forward-looking regulations. In fact, some argue Ripple has gone from being on the defensive to becoming a leading voice in crypto policy advocacy, a role that no one would have predicted just a few years ago. Now, what about XRP itself? At the time of this recording, XRP remains a top 10 cryptocurrency by market cap. It may not be the speculative rocket ship it once was during the 2017 bull run, but its position is solid. That's because XRP isn't just a token anymore. It's a critical part of a growing, functioning financial infrastructure. Banks, remittance services, and payment providers are using XRP in real-world transactions across dozens of countries. That's utility, not hype. Yet the debates haven't gone away. There are still critics who point to Ripple's large XRP holdings as proof that the system is too centralized. Others believe XRP's biggest competition won't come from other cryptocurrencies, but from CBDCs, stablecoins, and payment giants like Visa and PayPal who are building their own settlement rails. And don't forget Stellar, the project born out of Ripple's own internal split. It still competes in similar corridors with a similar pitch: fast, cheap, borderless payments. So where do things stand? XRP is no longer the wild card it once was. It's matured. It's survived one of the most aggressive regulatory attacks in crypto history. It's evolved its technology, expanded its use cases, and pushed deeper into global markets. It's not just trying to make a comeback. It never left. But perhaps the most important takeaway right now is this: XRP's story isn't finished. We're not at the end. We're at a new beginning. And what happens next could redefine not just XRP's future, but the future of the entire financial system. Okay, now we covered the big three. Next on the line is Speed Demon, and his name is Solana. So, without wasting more time, let's go back to 2017 and explore the very beginning. While Bitcoin dominated headlines and Ethereum was fueling ICO mania, a former Qualcomm engineer named Anatoly Yakovenko had a different idea. He was frustrated with one core problem: blockchains were just too slow. Drawing from his background in distributed systems and wireless technology, Anatoly proposed a radical solution, something called proof of history. Unlike Bitcoin or Ethereum at the time, which relied on block times and miners or validators waiting their turn, proof of history introduced a cryptographic clock that could timestamp events automatically and in order. No waiting, no guessing. This would allow thousands of transactions to happen in parallel, drastically speeding things up. In November 2017, Yakovenko released the first white paper outlining this idea. He soon teamed up with Greg Fitzgerald, another Qualcomm colleague and low-level systems wizard, to build the initial prototype. When it worked, they knew they were onto something. Soon after, Raj Gokul joined to help shape the business and product vision. Together, they assembled a team of engineers and early crypto believers with one goal: build the fastest blockchain on Earth. By late 2018, the trio officially launched Solana Labs, the company that would drive protocol development. The name Solana itself came from a small beach town near San Diego, where the founders used to surf. With a technical blueprint in place and a lean but ambitious team, Solana Labs set its sights on creating a high-performance Layer 1 blockchain that could one day rival centralized systems in both speed and cost. At a time when most chains were still figuring out smart contracts, Solana was already designing the rails for Web3 to run at internet scale. The foundation was laid, and the Speed Demon was born. It was time to bring the idea to life, and that is exactly where our next topic leads us. After laying the theoretical groundwork and assembling a high-caliber team, Solana Labs entered the next critical phase: turning vision into reality. In 2019, the team launched a public testnet known as Tour de Sol, designed to push their new consensus model to the limit. This wasn't just a small-scale demo, it was a full-blown stress test for the real world. aimed at proving that proof of history combined with Tower BFT, Byzantine fault tolerance, could support massive throughput without sacrificing security. The crypto world started paying attention. Solana began raising capital from top-tier investors like A16Z, Andreessen Horowitz, Multicoin Capital, and Coinbase Ventures, eventually completing multiple funding rounds, including a substantial Series A. This influx of capital helped scale the engineering team, refine the protocol, and prepare for launch. Then came the big moment. In March 2020, Solana mainnet beta officially went live. While labeled a beta, it was fully functional and already demonstrating something few blockchains could, up to 65,000 transactions per second with near zero fees. That wasn't marketing hype. It was a glimpse into what blockchain performance could look like in the future. What made Solana's launch different was its monolithic design. Unlike Ethereum's modular, layer-heavy approach, Solana chose to integrate everything into one layer: consensus, execution, and data availability, all on-chain. This allowed for blistering speed, but also introduced high hardware demands, which would later become a topic of debate. Regardless, the early launch phase was a success. Developers now had access to a new kind of blockchain, one that felt closer to internet infrastructure than the clunky systems they were used to. The speed demon had left the garage and was already tearing up the track. And as you might expect, the next step was to start building the ecosystem around it, which takes us into our next chapter. Once the mainnet was live, Solana's next challenge was clear: build an ecosystem that proves the tech is useful. And that's exactly what started happening between mid-2020 and early 2021, a period that would lay the groundwork for Solana's explosive rise. To support growth and adoption, the Solana Foundation was established. Its mission? Help fund developers, encourage global adoption, and promote ecosystem tools. Backed by grants and partnerships, the foundation began onboarding the first wave of builders who were eager to test what this speed demon chain could do. One of the earliest and most important projects was Serum, a decentralized exchange, DEX, built by FTX and Alameda Research. Unlike Ethereum-based DEX that suffered from high gas fees, Serum on Solana could execute trades at lightning speed and microscopic cost. This wasn't just a nice-to-have, it was a game-changer for traders and liquidity providers. Serum became a major validator of Solana's tech, attracting even more attention from developers in the DeFi space. At the same time, Solana's developer activity surged. More dApps, decentralized apps, were launching, from early NFT experiments to DeFi protocols and infrastructure tools. Integrations with USDC, Chainlink, and hardware wallets created a more complete toolkit for users and developers alike. Projects like Phantom Wallet began emerging during this period too, making Solana more accessible to the average crypto user. For the first time, Solana had the basic components of an ecosystem: fast chain, active builders, liquidity, and user-friendly access. By early 2021, it was becoming clear that Solana was more than just a fast blockchain. It was shaping up to be a serious contender in the Layer 1 wars. And that set the stage for the next phase: Solana Summer, a term that would soon take on legendary status. What came next was nothing short of explosive: the rise of what the crypto community would dub Solana Summer. Starting in mid-2021, Solana went from promising new Layer 1 to one of the hottest names in crypto, attracting developers, traders, NFT artists, and VCs in waves. So what exactly made Solana Summer so iconic? First, the DeFi ecosystem exploded. Total value locked, TVL, in Solana-based protocols surged as projects like Radium, Saber, and Orca gained traction. With super low fees and lightning-fast execution, Solana gave traders and yield farmers a new playground, one that didn't cost $50 per transaction like Ethereum did at the time. Then came the NFT boom. Platforms like Solanart and Digital Eyes emerged, launching collections that would become Solana blue chips: Degenerate Ape Academy, Solana Monkey Business, and Orrery, just to name a few. What made this unique was the user experience. Minting NFTs on Solana was fast, cheap, and simple. This drew in a flood of newcomers who found Ethereum's gas fees intimidating. Of course, all of this led to one thing: a massive price rally. Sol, the native token, skyrocketed from under $30 to over $250 in just a few months. It entered the top 10 cryptocurrencies by market cap, and major media outlets began calling it the Ethereum killer. But it wasn't all smooth sailing. For the first time, performance cracks began to show. High-demand events like NFT mints triggered network slowdowns. Still, the community largely saw these as signs of success, growing pains from rapid adoption. In short, Solana Summer wasn't just a meme, it was a breakout moment. It proved that Solana could host real apps, attract real users, and handle serious demand, all while making crypto faster and more affordable for the masses. But every story has its problems. So does this one. Now we enter one of the most challenging chapters in Solana's journey, a time marked by growing pains, technical failures, and questions about the network's future. As incredible as Solana Summer was, it also brought the first true stress test of the network. In September 2021, the blockchain suffered a major outage lasting 17 hours. The culprit? A flood of spam transactions, over 400,000 per second, triggered by bots during an IDO, initial DEX offering. The network simply couldn't handle it. Validators fell out of sync, consensus broke down, and Solana had to coordinate a manual restart with its community. This was more than just a hiccup. It was a reality check. Developers, users, and critics all asked the same thing. Is Solana too centralized? After all, the coordinated validator reboot and the high hardware requirements had already sparked debate. Many pointed out that running a full Solana validator required far more powerful machines than other blockchains, potentially making it a playground for well-funded players rather than a truly open system. And yet, despite the criticisms, user activity kept growing. Wallets like Phantom continued to gain traction as the go-to interface for NFTs and DeFi. People loved the speed and low fees, even if the infrastructure needed more work under the hood. But congestion issues didn't go away. In fact, 2022 brought more minor outages, particularly during peak traffic events like popular NFT drops. Solana developers scrambled to optimize the network and introduce patches, but the perception was taking a hit. The question hanging in the air was simple: can Solana scale without falling apart? Still, it wasn't doom and gloom. The community stuck around. Builders kept building. The user base remained passionate. But the honeymoon was over. Solana had entered the prove-yourself phase, where performance had to catch up to ambition. Next, we head into even darker territory: the collapse of one of Solana's biggest backers, and the fallout that shook the entire ecosystem. The next chapter in Solana's journey was not a technical failure, but a shockwave from the broader crypto industry, and it hit closer to home than anyone expected. In late 2022, the collapse of FTX, once the second largest crypto exchange in the world, sent ripple effects across the ecosystem. But for Solana, it was more than a ripple. It was a tsunami. Why? Because FTX and its sister company, Alameda Research, were two of Solana's biggest backers. They had poured significant investment into the Solana ecosystem, launched major DeFi projects like Serum on its blockchain, and heavily promoted Solana as part of their broader vision. When FTX imploded in November 2022 amid fraud allegations and a liquidity crisis, confidence in anything tied to FTX vanished, including Solana. The results were brutal. Sol's price dropped over 60% in just a few days. Billions in value were wiped out from the ecosystem. Developers and users panicked. Projects like Serum had to be restructured, and anything with even a slight FTX connection became radioactive overnight. The damage wasn't just financial, it was psychological. People questioned whether Solana was truly independent or if it had relied too heavily on FTX's support. Critics resurfaced concerns about centralization. Headlines proclaimed Solana dead or dying. And yet, amid the rubble, the chain kept running. Solana's core community, the devs, the validators, the builders, didn't leave. In fact, some saw the collapse as a chance to start fresh. Without FTX's influence, the project could finally prove itself on its own merit. The moment was dark, but the fire hadn't gone out. This event marked a turning point. Solana was no longer the darling of VCs and influencers. It was a survivor, forced to rebuild from the ground up. And what came next was a story of resilience, decentralization, and rebirth. After the storm of the FTX collapse, many expected Solana to fade. But instead, something unexpected happened: a grassroots resurgence. 2023 became the year Solana proved it wasn't just a product of hype and VC money. It was a project with real builders, real users, and a community that refused to quit. Developers stayed. Not all, but enough. And new ones arrived too. The open source spirit kicked in, with teams forking FTX-related projects, rewriting code, and restoring user trust. Serum, once tightly linked to Alameda, was revived by the community. The blockchain kept running, and people kept building. The ecosystem slowly pivoted away from centralized dependence. Grants from the Solana Foundation, community-led events, and open hackathons started to shape a more decentralized culture. Instead of relying on a few dominant players, the spotlight shifted to dozens of independent projects, many of which had nothing to do with FTX. Notably, several Web3 powerhouses began migrating to Solana. Helium, a decentralized wireless network, moved from its own chain to Solana to improve scalability. Render Network, focused on distributed GPU computing, followed. HiveMapper, a decentralized mapping platform, also chose Solana for its high throughput. These were serious, real-world use cases, and they brought credibility back to the chain. Solana's reputation started to rebuild, not because of price action, but because it refused to die. Builders were no longer just chasing hype. They were laying bricks in a quieter, more resilient version of the network. By mid-2023, the tone around Solana had shifted. It wasn't about flashy launches anymore. It was about earning respect. And that's exactly what it was starting to do. And that brings us to our next topic. With momentum slowly building again, Solana began preparing for its most ambitious leap yet, solving its lingering scalability challenges once and for all. Enter FireDancer, a high-performance validator client being developed by Jump Crypto, one of the most prominent trading and infrastructure firms in the space. Until now, Solana's biggest technical criticism had been its network reliability during high demand. Although it boasted massive throughput, its single validator client, built by Solana Labs, was prone to bugs and bottlenecks. FireDancer aimed to fix that, not just by patching issues, but by rebuilding the client from scratch in C++, with performance and modularity at its core. The vision? To enable hundreds of thousands of transactions per second, with true redundancy, robust performance, and a drastically reduced risk of outages. What made FireDancer a game changer wasn't just speed. It introduced client diversity to the Solana network, a critical component of decentralization and resilience. With more than one validator implementation, the risk of a single bug crashing the whole chain was dramatically lowered. This brought Solana closer to the standards of major systems like Ethereum, which already benefited from multiple independent clients. Throughout late 2023 and into 2024, development on FireDancer accelerated. Public demos showed eye-popping transaction benchmarks. The Solana Foundation poured resources into research and testing, ensuring FireDancer would integrate smoothly into the validator ecosystem. The narrative shifted. Solana wasn't just rebuilding, it was future-proofing. FireDancer became a symbol of long-term scalability, drawing interest from infrastructure providers, validator operators, and institutional partners. For a network once mocked for crashing under pressure, FireDancer offered redemption and a clear signal that Solana wasn't just aiming to survive the next bull run. It was building to dominate it. And that brings us to 2024. With scalability upgrades like FireDancer underway, 2024 marked a turning point, not just in Solana's infrastructure, but in its application layer. This was the year Solana's comeback truly took shape through NFTs, gaming, and mobile, signaling a pivot toward mainstream, user-facing use cases. Let's start with NFTs. After surviving the 2022-2023 crypto winter, the NFT scene on Solana bounced back strong. Collections like Mad Lads, Tensorians, and Claynosaurs gained popularity, while marketplaces such as Magic Eden refined their platforms and solidified Solana's role as a hub for digital collectibles. The fast, cheap minting experience made it a preferred chain for creators and collectors alike. But Solana wasn't just a playground for JPEGs. Gaming also began to mature. Projects like Star Atlas and Aurori entered new development phases, showcasing real gameplay and blockchain integration. Other Web3 native titles began to emerge, capitalizing on Solana's ability to support real-time in-game economies without lag or high fees. With Web3 gaming still in its early days industry-wide, Solana positioned itself as a high-performance backend for next-gen interactive platforms. Perhaps most notably, Solana Mobile launched its flagship device, the Saga smartphone. This wasn't just a crypto phone. It featured a built-in Solana wallet, dApp store, and seamless integration with blockchain apps. The idea was bold: turn mobile devices into native Web3 platforms. While initial adoption was modest, the move set Solana apart. No other major blockchain had ventured this far into hardware. All of this showed that Solana wasn't content with just rebuilding. It was expanding. NFTs, games, and mobile tech brought users back and gave developers clear, tangible platforms to build on. In 2024, Solana didn't just run fast. It started to run everywhere. All right, we covered past. Let's see where we are today. By mid-2025, Solana has completed a remarkable transformation from a fast but fragile blockchain to a full-fledged, resilient ecosystem. It's no longer chasing Ethereum's shadow. Instead, Solana has carved out its own identity as a high-performance platform powering consumer-facing Web3 apps across gaming, payments, social, and mobile. With FireDancer now widely adopted, the network boasts unprecedented scalability and uptime. finally resolving the reliability concerns of its earlier years. Decentralization has also improved, with a broader, more diverse validator set and multiple independent client implementations. This technical foundation has enabled the next wave of innovation: mobile native dApps, real-time blockchain games, NFT-rich platforms, and even payment systems rivaling traditional fintech in speed and cost. Solana Mobile continues to evolve, pushing the vision of Web3 in your pocket, while projects across verticals, from decentralized finance to creator tools, thrive thanks to low fees and seamless user experience. SOL, the native token, has made a strong price recovery, reflecting renewed trust from both developers and investors. But the competition hasn't disappeared. Ethereum, Layer 2s, and emerging chains still vie for dominance. Solana's edge lies not in being first or biggest, but in being fast, accessible, and now battle-tested. From chaotic outages and existential crises to a stable, expanding ecosystem, Solana's 2025 is no longer about proving itself. It's about scaling what it already does best. The speed demon hasn't just survived, it's evolved into a powerhouse. And our fifth currency to cover is Cardano, or ADA. Let's dive in. So without wasting time, let's start at the very beginning. In the early days of crypto, most projects were launched by developers who embraced the move fast and break things approach. But Cardano was different from the start. Its creator, Charles Hoskinson, envisioned something much more deliberate. You see, Charles was one of the original co-founders of Ethereum, but he left Ethereum in 2014 over disagreements about the project's future, particularly around governance and funding. While others wanted Ethereum to be a profit-driven company, Charles wanted a more academic, decentralized approach. After parting ways, he co-founded IOHK, Input Output Hong Kong, a research-driven tech company designed to build blockchain infrastructure with scientific rigor. With a team of computer scientists, cryptographers, and researchers from top universities, IOHK began working on a new kind of blockchain, one that would be peer-reviewed, formally verified, and built to last. Cardano wasn't trying to be the fastest or flashiest chain. It was aiming for robustness and sustainability. Every part of its architecture was designed from scratch and validated by academic papers. The philosophy was clear: take the time to do it right, even if it meant being slow to launch. In September 2017, Cardano officially launched its first phase, called Byron. This version introduced the ADA token and served as a settlement layer. Basically, a secure base to handle transactions, but without smart contracts yet. Still, it attracted attention for its clean design, energy efficiency, and unique consensus model called Ouroboros, the first proof-of-stake algorithm proven secure in academic literature. From day one, Cardano stood out as a blockchain that prioritized math over marketing and principles over speed. It wasn't for hype chasers. It was for those who believed in building something that could last for decades. After Cardano's launch in 2017 with the Byron phase, the project entered what some called its quiet years. But behind the scenes, the work was anything but quiet. IOHK and its team of researchers doubled down on formal development, writing dozens of peer-reviewed papers on everything from consensus theory to network architecture. While the rest of the crypto world rushed to release products, Cardano was still building its foundation, line by line, paper by paper. This deliberate pace drew criticism. Some called it vaporware. Others joked that Cardano was the most academically cited blockchain with no smart contracts. But believers saw something else: a project that valued security, decentralization, and long-term vision over short-term hype. And while the network remained minimal in features, ADA was actively traded, and the community quietly grew into one of the most passionate in crypto. The breakthrough came in July 2020, when Cardano launched its Shelly upgrade. This was no minor update. It marked the transition from a federated network, where IOHK and its partners ran the nodes, to a decentralized one where the community could operate the network. At its heart was the introduction of proof of stake, making ADA holders part of the consensus process. Suddenly, anyone could set up a staking pool or delegate their ADA to one, and earn passive rewards for helping secure the network. The number of pools surged past 1,000 within months, quickly making Cardano one of the most decentralized blockchains by node count. This moment, Shelly, was a turning point. It proved that Cardano wasn't just theory, it was real, decentralized, and capable of running at scale. More than just a technical upgrade, it was a validation of the slow and steady approach Charles and IOHK had championed all along. By 2021, Cardano had successfully proven it could decentralize. But now came the real test: Could it compete with Ethereum as a platform for smart contracts and decentralized applications? This next chapter, known as the Goguen Era, would be one of the most highly anticipated and closely watched moments in Cardano's history. For years, critics said Cardano was all talk. There were academic papers, whiteboards full of diagrams, and Charles Hoskinson's regular video updates, but still no smart contracts. That changed in September 2021 with the Alonzo hard fork, which officially activated Plutus smart contracts on the mainnet. Finally, developers could begin building real applications directly on Cardano's blockchain. But there was a catch. Plutus was based on Haskell, a programming language known for its precision and security, but also its steep learning curve. Unlike Solidity on Ethereum, Plutus wasn't beginner-friendly. While powerful and mathematically rigorous, it posed challenges for new developers trying to build quickly. Still, the rollout was a symbolic and functional milestone. For the first time, Cardano could host DeFi, NFTs, and dApps, all on-chain. The ecosystem sprang into action, though it took time for tools and platforms, such as wallets, explorers, and APIs to catch up. Projects began to deploy, but many encountered early issues with concurrency and transaction throughput, leading some to call Cardano's smart contracts too academic for real-world use. Despite the rough start, the community stayed engaged, excited by the possibilities. Cardano wasn't aiming to be flashy. It was aiming to be robust. And with Plutus now live, the blockchain finally had the functionality it had promised since 2017. Goguen marked the moment when Cardano moved from potential to practice. The infrastructure was still maturing, but the foundation was finally there, and the world was watching. With smart contracts now live, the Cardano ecosystem faced its next major milestone: real-world adoption. The second half of 2021 into early 2022 saw the emergence of DeFi protocols, NFT projects, and a growing number of users interacting with Cardano in ways never before possible. But it also marked the beginning of new and very real challenges. One of the earliest and most anticipated DeFi projects was SundaySwap, a decentralized exchange designed to bring AMM, automated market maker, functionality to Cardano. Its launch in early 2022 drew massive attention and just as much scrutiny. As soon as trading went live, the network became congested. Transactions were delayed for hours. Critics pounced, declaring that Cardano's fancy academic designs couldn't handle real demand. At the heart of the issue was Cardano's EUTXO model, a variation of Bitcoin's transaction structure that prioritizes security and determinism. While this model prevents many smart contract bugs seen on Ethereum, it introduced new limitations, particularly around concurrent transactions. Developers had to innovate around these constraints, which took time and effort. Meanwhile, NFTs took off in an unexpected way. Even before Plutus smart contracts, users found creative ways to mint and trade NFTs using native tokens. By early 2022, Cardano had a thriving NFT community, with marketplaces like cnft.io and jpg.store gaining traction. The low fees and strong community vibe made Cardano an attractive home for artists and collectors, even if the tech was still evolving. As the network strained under demand, questions emerged. Was Cardano too slow to scale? Was its design too complex for rapid growth? Supporters pointed out that slow, careful development was part of the plan. Critics wanted more immediate results. Either way, the pressure was on. Cardano had proven it could run smart contracts. Now, it had to prove it could scale and survive the flood of real usage. After launching smart contracts in 2021, Cardano entered its next critical phase: scaling. This phase, known as the Basho Era, was designed to improve the network's performance, throughput, and infrastructure without compromising its core principles of decentralization and formal verification. One of the first major upgrades was the Vasil hard fork, named after the late Cardano community member Vasil Dabov. Activated in September 2022, Vasil introduced key improvements to the Plutus smart contract language, enabling greater efficiency and flexibility for developers. It also optimized how transactions were processed, allowing multiple operations to be batched into a single block more effectively. This upgrade marked a turning point. It showed that Cardano could improve its performance without disrupting its careful architectural design. But Vasil was just the beginning. IOHK began developing Hydra, a Layer 2 scaling solution designed to handle high-throughput use cases like micropayments, gaming, and real-time applications. Hydra works by creating multiple heads, or off-chain ledgers, that connect to the main chain but process transactions independently. The result? Drastically increased capacity while keeping fees low and finality fast. Cardano also began experimenting with input endorsers, a future feature aimed at boosting block propagation and parallelism. These innovations were part of a larger effort to make Cardano capable of supporting global-scale financial applications and enterprise-level adoption. Beyond performance, interoperability became a focus. IOHK started work on sidechains, allowing other blockchains or systems to connect to Cardano securely. This meant Ethereum developers, for example, could eventually bring their apps to Cardano's environment with minimal friction. Through all of this, Cardano stayed true to its methodical philosophy. Critics still called it slow. Supporters saw a platform maturing at its own pace, deliberately, but with purpose. By the end of 2023, Cardano hadn't just scaled, it had laid the foundations for a blockchain that could adapt, expand, and evolve for decades to come. While most crypto projects chased short-term gains or speculative hype, Cardano quietly leaned into real-world impact and long-term strategy. In 2023, that meant two things: working with governments in Africa and positioning as a regulation-friendly digital asset. Cardano's African ambitions weren't new, but in 2023, they began to materialize in meaningful ways. One of the most prominent projects involved a partnership with the Ethiopian government to create blockchain-based digital identities for millions of students and teachers. The goal? Improve transparency in education, provide tamper-proof records, and give students a portable, verifiable academic history. This wasn't a pilot. It was a large-scale deployment, backed by IOHK's tech and local engagement. Other efforts included work on land registry systems, mobile infrastructure for banking the unbanked, and creating transparent government systems through blockchain-based records. These initiatives showcased Cardano's vision of blockchain for social good, a stark contrast to the image of crypto as speculative gambling. Simultaneously, Cardano started to shine in regulatory discussions. As global governments tightened crypto oversight, ADA gained attention as a compliant, academically grounded asset. Cardano's layered architecture, transparent governance plans, and formal methods made it easier to present as a responsible blockchain, not an anonymous free-for-all. Its partnerships with educational and governmental institutions added to this credibility. Unlike other blockchains that faced SEC lawsuits or were delisted over compliance concerns, ADA managed to avoid major regulatory clashes in 2023. Some saw this as a competitive edge, a blockchain that could scale within the system rather than against it. Of course, these moves didn't generate Twitter buzz or massive price pumps, but they weren't supposed to. They were long-term plays, bets that utility, reputation, and regulatory readiness would pay off in the next wave of adoption. By the end of 2023, Cardano wasn't the loudest player in crypto, but it was building something many others weren't: trust. By 2024, Cardano entered what might be its most ambitious and defining phase yet: Voltaire. Named after the Enlightenment thinker, this phase wasn't about speed or scale. It was about self-governance. Cardano aimed to become the first major blockchain to be truly run by its community. Voltaire introduced a full on-chain governance system where ADA holders could vote on development proposals, funding allocations, and even changes to the protocol itself. Think of it as a decentralized democracy baked into the very core of the blockchain. The days of relying solely on IOHK or the Cardano Foundation were over. Power was shifting into the hands of the network's users. This system was powered by a treasury, a pool of ADA set aside specifically for community-approved projects. Anyone could submit a proposal, and if it gained enough support through voting, it would receive funding. This wasn't theoretical. In 2024, dozens of proposals were already funded, from developer tools and educational materials to ecosystem-wide infrastructure upgrades. The governance process was designed to be formal, transparent, and secure. IOHK implemented it using peer-reviewed systems like Catalyst and DREP, delegated representatives, to strike a balance between accessibility and informed decision-making. Critics questioned whether the average ADA holder was equipped to make technical decisions. Supporters argued that decentralized power was the whole point, and that Cardano's formal governance approach offered a framework to educate and empower its community. Most importantly, Voltaire addressed a question most blockchains avoid: who leads in the long run? Cardano now had an answer: everyone who holds ADA. With Voltaire, Cardano became more than just a smart contract platform. It became a self-sustaining, self-improving protocol, guided not by a founder or company, but by a global community with real power and real responsibility. By 2025, Cardano had fully matured, delivering on many of its long-held promises, even if public perception hadn't caught up. To many outside the ecosystem, Cardano still carried an outdated image. Too slow, too academic, or too boring. But under the hood, the reality was very different. Smart contracts were now widely deployed. DeFi apps, NFT platforms, identity services, and DAO tooling had all taken root. More importantly, they were functioning efficiently and securely. Thanks to improvements like the Vasil hard fork and subsequent network upgrades, transaction throughput had increased significantly. Developer tooling, once seen as a barrier, had become more user-friendly through community-driven efforts. One of Cardano's most promising innovations in 2025 was Hydra, a Layer 2 protocol designed for microtransactions and real-world scalability. Hydra heads allowed parts of the network to scale independently, enabling use cases like point-of-sale payments, games, and high-frequency applications, all without congesting the main chain. For a protocol once mocked for being too slow, this was a bold rebuttal. And then there was governance. After Voltaire's rollout in 2024, Cardano had fully embraced community-led development. Treasury-funded projects were flourishing, and decentralized representatives, DREPs, had begun to shape the protocol's roadmap. No longer reliant on IOHK or any single entity, Cardano had become one of the most self-governed blockchains in existence. Still, it wasn't perfect. Cardano faced challenges in attracting developers compared to trendier platforms like Solana or Avalanche. Its Haskell-based language, Plutus, remained powerful but hard to master, and its slower, methodical approach sometimes made it feel disconnected from the fast-moving crypto zeitgeist. Yet ADA remained in the top 10-15 by market cap. It wasn't because of hype, but because it worked. Secure, sustainable, scalable, governed by its people. Cardano in 2025 wasn't chasing attention. It was building something that could last. Okay, our sixth currency is Stellar XLM. Many consider it as main competitor of XRP, and you will soon understand why. To understand Stellar, you need to go back to 2014, a year when the crypto space was still in its early, chaotic phase. That's when Jed McCaleb, a key figure behind Ripple, XRP, decided to part ways with the company he helped create. McCaleb had grown increasingly frustrated with Ripple's direction, particularly its centralized governance and focus on servicing large banks. He believed blockchain should empower individuals, not just institutions. So he teamed up with Joyce Kim, a lawyer and entrepreneur, to launch a brand new project, Stellar. Their vision was clear from the beginning: build an open-source, decentralized financial network accessible to everyone, especially people in developing economies who had limited access to banking. It wouldn't just be another crypto asset. Stellar aimed to connect the world's financial infrastructure in a permissionless and inclusive way. To support this mission, they founded the Stellar Development Foundation, SDF, a nonprofit organization that would guide the project's long-term development. This was a key difference from many profit-driven blockchain startups at the time. Instead of raising capital through a token sale or ICO, Stellar received $3 million in seed funding from Stripe, one of the most respected fintech companies in the world. From day one, Stellar's focus was on usability and impact, not hype. The network launched with a modified version of Ripple's codebase, but it quickly became clear that Stellar would go its own way. It wasn't about building for traders or speculators. It was about financial inclusion, low-cost transactions, and building a public infrastructure layer for money, similar to how the internet became a public layer for information. This founding vision laid the groundwork for everything that would follow. Stellar wasn't designed to compete for headlines. It was created to quietly revolutionize how money moves across borders. Every ambitious project faces a rocky start, and Stellar was no exception. After launching in mid-2014, the Stellar network initially used a forked version of Ripple's consensus algorithm, but that decision quickly proved problematic. Within months, the network ran into technical bugs, security issues, and poor scalability. The system wasn't stable, and confidence began to shake. Critics questioned whether Stellar was just Ripple in disguise. But rather than pushing forward with a shaky foundation, Stellar took a step back, and that turned out to be a defining moment. In 2015, Stellar introduced an entirely new consensus model, one that would set it apart from virtually every other blockchain at the time. It was called the Stellar Consensus Protocol, SCP, and it was created by David Mazières, a Stanford professor and renowned cryptographer. Unlike Bitcoin's proof of work or even Ripple's early consensus design, SCP was based on a concept called Federated Byzantine Agreement, FBA. That's a mouthful, but the key idea is simple. Instead of relying on miners or a centralized set of validators, SCP allows participants to choose their own trusted quorum slices, forming a web of overlapping trust relationships. This creates decentralization, but in a flexible, permissioned way. The benefits? Fast confirmation times, low energy usage, and a network that could scale without traditional mining. It was a bold step, especially since SCP was peer-reviewed and academically published, staying true to Stellar's mission of combining rigorous research with real-world impact. Still, this wasn't an overnight turnaround. The early years were slow and often quiet, but by ditching Ripple's tech and building its own protocol, Stellar began to carve out its unique path. It wasn't about being a clone. It was about becoming a truly independent, purpose-driven blockchain for global finance. After rewriting its core protocol with the Stellar Consensus Protocol, SCP, Stellar entered a critical phase, building a stable, secure, and scalable foundation. These years weren't flashy, no price explosions or viral NFT drops, but they were pivotal. This was when Stellar transitioned from concept to actual financial infrastructure. The Stellar Development Foundation, SDF, focused heavily on protocol reliability and developer tooling. They improved the stability of the network, added multi-signature support, enhanced account management, and introduced features that made Stellar more attractive for real-world financial applications, like issuing custom tokens directly on the network. This wasn't just a theoretical upgrade. It opened the door for companies and fintech platforms to create stablecoins, loyalty points, remittance tokens, or even local currencies, all on Stellar's rails. And that aligned perfectly with Stellar's mission: democratize access to money, especially in parts of the world underserved by traditional finance. And then came a major turning point: partnerships. In 2017, Stellar made headlines by partnering with IBM. That collaboration was a massive credibility boost. IBM wanted to build cross-border payment infrastructure using blockchain, and they chose Stellar. Not Ethereum, not Ripple, not Bitcoin. The result was IBM WorldWire, a global payment system designed to connect financial institutions using Stellar's network. This gave Stellar a unique positioning. While others chased ICOs or experimental dApps, Stellar built relationships with banks, remittance providers, and governments. It was becoming the blockchain that traditional finance could actually use. During this period, Stellar also began working with companies like Tempo in Europe and Coins.ph in Southeast Asia, early examples of using blockchain for real-world remittances and mobile money. By the end of 2017, Stellar had done something rare in crypto. It kept a low profile, avoided hype, and quietly laid the groundwork for what would become a real-world payment network. As the crypto market exploded in 2017, Stellar found itself pulled into the spotlight. While Bitcoin and Ethereum grabbed headlines, Stellar's combination of speed, low fees, and tokenization tools made it a hidden gem for startups looking to launch their own crypto assets. It was the ICO era, and Stellar became a surprising player in the token boom. The price of XLM, Lumens, skyrocketed alongside the rest of the market, pushing it into the top 10 cryptocurrencies by market cap. Investors started paying attention, but what really set Stellar apart was its utility. While Ethereum dominated the smart contract space, Stellar offered a simpler and cheaper alternative for projects that didn't need complex logic, just fast, secure token transfers. This is when dozens of projects began launching tokens on Stellar. It wasn't just about hype, it was about practical, usable infrastructure. Stellar's design, based on fast finality and fixed low fees, made it ideal for companies focused on payments and remittances. The most high-profile partnership during this time? IBM's WorldWire, a cross-border payment network built entirely on the Stellar blockchain. IBM began onboarding banks and financial institutions across Africa, the South Pacific, and Latin America, using Stellar to settle transactions in near real time. This wasn't vaporware. It was a working system tested with actual banks. Stellar also gained traction with fintech companies like Satoshi Pay, which used the network for microtransactions, and SureRemit, which targeted remittances to developing nations. But despite the surge in attention, Stellar avoided becoming a hype chain. The Stellar Development Foundation stuck to its mission: enable accessible financial infrastructure, not ride market waves. By the end of 2018, Stellar had not only survived the ICO era, it had used it to quietly grow. While others chased speculation, Stellar kept building for real-world finance. After the crypto market cooled in 2018, many projects faded, but Stellar kept moving. Between 2019 and 2020, the Stellar Development Foundation, SDF, focused on turning its vision into practical reality. This wasn't about hype anymore. It was about real-world adoption. Stellar doubled down on remittances and financial inclusion, forming partnerships with companies that were already serving underserved populations. One example was Satoshi Pay, which enabled cross-border microtransactions and media payments using Stellar. Another was Tempo, a French remittance provider that used Stellar to power fast and affordable money transfers across Europe and Africa. In 2019, SDF launched the Stellar Enterprise Fund, committing up to $120 million to support startups building on the network. This fund aimed to boost innovation around tokenization, payments, and digital identity, critical areas for global financial access. Perhaps one of the most significant milestones came in 2020, when XLM was added to more major exchanges, including Coinbase. This gave users easier access to Stellar, especially in North America. At the same time, Stellar improved its wallet infrastructure, with tools like Lobster and Solar Wallet providing smoother user experiences. On the tech side, Stellar added more features to support custom asset issuance, multi-signature accounts, and compliance tools, making it more attractive for fintechs and institutions looking for stable, auditable platforms. But what really stood out was Stellar's approach. No flash, no drama. While many blockchains pivoted to DeFi or NFTs, Stellar stayed focused on being a global settlement layer. It became known as the quiet builder, not making noise, but building tools that worked. By 2020, Stellar wasn't just an idea. It was a functioning network with real users, real partners, and real value flowing through its rails. As other blockchains chased the latest crypto fads, Stellar spent 2020 and 2021 strengthening its foundation. This wasn't about keeping up with trends. It was about refining what Stellar already did best: fast, low cost, and secure payments. The network underwent several important protocol upgrades, all aimed at improving performance, developer flexibility, and regulatory readiness. One of the biggest milestones during this period was the launch of Stellar USDC, a stablecoin issued by Circle, running natively on the Stellar network. This partnership enabled fast, dollar-denominated transfers across borders with near-zero fees. It instantly gave Stellar a competitive edge in the stablecoin game, especially for remittances and fintech apps. Behind the scenes, the Stellar Development Foundation continued to focus on enterprise needs. They introduced better support for multi-signature accounts, expanded asset control features, and optimized transaction throughput. These upgrades made it easier for regulated businesses to launch products without compromising compliance or performance. Meanwhile, Stellar deliberately stayed away from the DeFi mania sweeping through Ethereum. There were no yield farms, no meme tokens, and no complex derivatives. Instead, Stellar's message was clear. This is infrastructure for serious builders, not gamblers. The SDF also took regulation seriously. They released tools to help businesses with KYC AML compliance, preparing for the increasing scrutiny facing crypto platforms. While many networks tried to remain in regulatory gray zones, Stellar leaned into becoming regulator-friendly, a decision that would prove valuable in the years to come. In a time when hype ruled headlines, Stellar's approach was disciplined, focused, and professional. It didn't try to be everything. It just kept improving at what it was already good at. In 2022, while much of the crypto world chased speculative gains or struggled with volatility, Stellar doubled down on its real-world mission: financial access. The Stellar Development Foundation, SDF, focused on turning blockchain from a niche technology into a bridge between traditional finance and underserved communities. The biggest headline came from Stellar's partnership with MoneyGram, one of the largest money transfer companies in the world. Together, they rolled out a global system allowing users to convert physical cash into USDC on the Stellar network and back again at participating retail locations. This was a game changer for the unbanked and underbanked, especially in developing countries. Now, people could access digital dollars without needing a bank account. But Stellar didn't stop there. It expanded its infrastructure with more fiat on and off ramps, meaning users could easily move between crypto and traditional currencies. That included integrations with mobile money services and fintech startups focused on remittances and microfinance. On the compliance side, Stellar continued to build a reputation as a regulation-ready blockchain. The SDF rolled out new tools to help partners integrate KYC, Know Your Customer, and AML, anti-money laundering frameworks, making it easier for licensed institutions to interact with Stellar-based assets. Stellar also began exploring the future of government-issued digital currencies. It launched research partnerships and technical pilots focused on CBDCs, central bank digital currencies, especially in collaboration with countries in Latin America and Africa. This wasn't just theoretical. Stellar positioned itself as a credible technical layer for nations looking to modernize their monetary systems. By the end of 2022, Stellar had made clear that it wasn't just building for crypto enthusiasts. It was building a financial backbone for the world's overlooked and underserved. By 2023, the crypto spotlight was firmly on Ethereum's Layer 2s, Solana's speed, and the DeFi and NFT hype across multiple chains. Stellar, by contrast, remained mostly under the radar, but that doesn't mean nothing was happening. In fact, Stellar was quietly expanding its global utility. While other platforms battled over total value locked or NFT trading volume, Stellar focused on financial inclusion. The network continued supporting cash-to-crypto corridors, especially in countries where banking infrastructure is weak. Projects using Stellar offered citizens access to dollar-backed stablecoins like USDC, helping protect their savings from local currency inflation. Still, concerns emerged around centralization. Most validator nodes on the Stellar network were still operated by the Stellar Development Foundation or affiliated partners. While the Stellar Consensus Protocol doesn't require mining, critics argued that true decentralization hadn't yet been achieved. The SDF acknowledged the issue and outlined plans to encourage more diverse validator participation, but progress was slow. Stellar also stood out for what it didn't do. While other chains embraced DeFi, meme tokens, and NFT marketplaces, Stellar intentionally stayed away. There were no major NFT platforms or yield farming protocols built on Stellar, and that was by design. The SDF believed in a focused approach, aiming to build stable, compliant infrastructure for payments and asset tokenization, not the speculative side of crypto. As a result, Stellar lacked the retail buzz of its flashier rivals. But it was gaining ground in quiet, meaningful ways, particularly among NGOs, financial institutions, and governments interested in blockchain for practical use. Not, in short. 2023 showed Stellar's biggest strength and weakness. It wasn't trying to be the next crypto trend, it was trying to build the next generation of financial plumbing. By 2024, the regulatory environment around crypto had shifted dramatically. Governments across the globe were clamping down on unregulated exchanges, privacy coins, and DeFi protocols. Many projects struggled to adjust, but for Stellar, this new era played directly into its long-term strategy. From the beginning, the Stellar Development Foundation, SDF, had prioritized compliance, transparency, and partnerships with traditional institutions. That approach now began paying dividends. As regulators cracked down, Stellar stood out as a regulator-friendly alternative, a blockchain built not for speculation, but for financial infrastructure. This year saw a growing number of central bank digital currency, CBDC pilots exploring Stellar as their underlying network. Several emerging market governments began experimenting with issuing tokenized national currencies on Stellar rails, attracted by its simplicity, compliance features, and real-time settlement capabilities. Meanwhile, SDF continued building out compliance tools. KYC and AML layers were being baked into wallet and on-off-ramp infrastructure. Stellar-based fintechs could now offer user verification directly on-chain, making it easier to meet government regulations while still preserving the benefits of blockchain. Though Stellar still lacked a fully featured smart contract system like Ethereum, the network introduced limited scripting capabilities to enable programmable logic for things like payments and asset issuance. This allowed for some customization, without opening the door to risky, unaudited code that plagued other ecosystems. Most importantly, Stellar stayed focused. It didn't chase hype or pivot toward the latest trends. Instead, it positioned itself as a trusted backbone for regulated digital finance, appealing to NGOs, banks, and financial institutions looking for scalable, compliant blockchain rails. In 2024, as much of crypto was scrambling to adjust to new rules, Stellar was already there, quietly thriving in the world regulation had built. By mid-2025, Stellar isn't making headlines with explosive growth or billion-dollar meme coins, and that's exactly the point. While other chains chase hype cycles, Stellar has matured into something else entirely, a stable, specialized, and globally respected financial layer. Its mission remains laser-focused, to power fast, affordable cross-border payments and support the tokenization of real-world assets. This clarity of purpose has made Stellar a trusted name among governments, NGOs, and fintechs working in emerging markets and underserved regions. XLM, Stellar's native token, continues to play a vital but modest role. It facilitates liquidity and serves as a bridge asset between currencies, not as a speculative investment, but as infrastructure. As a result, price movements are relatively calm, and XLM sits comfortably within the top 25 cryptocurrencies by market cap. The network has also gained traction in CBDC projects, with at least 2 central banks running pilots or production systems using Stellar rails. This includes programmable payments, remittances, and government-to-citizen disbursements, all executed quickly, cheaply, and with regulatory oversight. What Stellar lacks in DeFi and NFT ecosystems, it makes up for in reliability. Developers working on payments, compliance tech, or humanitarian aid choose Stellar for its uptime, simple tooling, and active support from the Stellar Development Foundation. Funding is steady, documentation is thorough, and corporate partners feel comfortable engaging with the network. Critics may still call Stellar boring compared to flashier blockchains, but in a post-regulation world, being boring is a feature, not a bug. Stellar isn't here to reinvent the internet. It's here to upgrade the financial plumbing of the real world. And in 2025, it's doing exactly that. Okay, our 7th currency today is Binance Coin, or BNB. All right, let's start at the very beginning. The story of Binance begins in July 2017, right in the middle of one of crypto's wildest bull runs. A man named Changpeng Zhao, or simply CZ, launched Binance after raising $15 million through an initial coin offering, ICO. At the time, crypto exchanges were slow, clunky, and poorly designed. CZ saw a gap in the market and built something better, a fast, user-friendly platform that worked across multiple languages and supported dozens of cryptocurrencies. Alongside the exchange, he also launched Binance Coin, known by its ticker, BNB. This token first lived on Ethereum as an ERC20 token, with a maximum supply of 200 million coins. In the beginning, BNB's main use was simple. If you used it to pay for trading fees on Binance, you got a discount. But that one small feature sparked a big idea, the start of a token-powered crypto ecosystem. In just a few months, Binance exploded in popularity. Its combination of low fees, constant updates, and a growing list of supported coins helped it become one of the biggest exchanges in the world by trading volume. Traders loved the speed and the deals. Investors started speculating on BNB's potential, seeing it not just as a discount token, but as a way to share in Binance's success. CZ also introduced a clever mechanic. Every quarter, Binance would destroy a portion of BNB, permanently reducing its supply based on trading activity. This deflationary model gave BNB even more value over time. By the end of 2017, what started as a simple ICO project had become a cornerstone of the entire crypto world. Binance wasn't just an exchange, it was quickly turning into a brand, a platform, and a movement, and BNB was right at the heart of it. After Binance's explosive debut, the team wasn't interested in just running an exchange. They wanted to build an entire blockchain ecosystem. So in 2018 and 2019, they began expanding what BNB could do. One of the first major moves was the launch of Binance Launchpad, a platform for hosting initial exchange offerings, IEOs. These were new crypto projects that raised money directly on Binance, and the only way to participate was by holding and using BNB. This gave the token real utility and sparked new demand. But the biggest leap came in April 2019, when Binance officially launched its own blockchain, Binance Chain. Up until then, BNB had existed on Ethereum, but Binance wanted more control and performance. So they created their own high-speed chain and migrated BNB over to it. This new chain wasn't made for smart contracts like Ethereum. It was built for fast transactions and powering a decentralized exchange, DEX, known as Binance DEX. On this new chain, BNB played a central role. It became the gas token used to pay transaction fees. To further strengthen BNB's value, Binance also implemented quarterly token burns, using a portion of profits to permanently remove BNB from circulation. This deflationary strategy added scarcity over time, which many saw as bullish. Meanwhile, Binance kept adding features to its core exchange, including margin trading, futures, and new fiat gateways, and in each case, BNB played a role. Whether for discounts, staking, or trading utility, BNB was more than just a coin. It was the fuel for everything Binance was building. By the end of 2019, Binance had proven it wasn't just riding the crypto wave, it was shaping the entire landscape. And BNB was evolving from a simple fee token into the heartbeat of a growing ecosystem. In 2020, Binance took its next major leap, and it changed the crypto landscape all over again. In September, they launched Binance Smart Chain, BSC, a smart contract platform that worked alongside the original Binance chain. But this time, BSC was designed to be fully compatible with Ethereum, meaning developers could easily migrate their apps without starting from scratch. What made BSC stand out wasn't just compatibility, it was speed and cost. Ethereum had become slow and expensive during the DeFi boom, with gas fees soaring into the hundreds. In contrast, BSC offered lightning-fast transactions and fees that were just a fraction of a cent. And powering it all? BNB. On BSC, users needed BNB to pay for every transaction, making it the essential fuel for this entire new ecosystem. The timing couldn't have been better. DeFi, short for decentralized finance, was exploding. New platforms for lending, borrowing out, and trading without intermediaries were popping up everywhere. BSC attracted a wave of these projects, including PancakeSwap, which quickly became one of the biggest decentralized exchanges in the world. Yield farming, staking, liquidity pools, BSC became a playground for crypto users seeking returns, and BNB's value surged as a result. By the end of 2020, Binance Smart Chain was one of the busiest blockchains on the planet. It had become a viable alternative to Ethereum, especially for users in regions where high fees made crypto inaccessible. And behind that success was BNB, now serving as gas, collateral, staking asset, and governance token across the entire BSC ecosystem. What began as a way to save on trading fees had transformed into one of the most used tokens in crypto. Binance had built a full-stack ecosystem, and BNB was at the center of it all. If 2020 was the year Binance built its empire, then 2021 was the year it took center stage. As crypto markets exploded into a historic bull run, BNB became one of the biggest winners. Starting the year around $40, BNB skyrocketed to over $600 by May, cementing itself as a top 3 cryptocurrency by market cap. The world started noticing. What drove this meteoric rise wasn't just speculation, it was utility. People were actively using BNB for everything. Trading fee discounts, DeFi transactions on BSC, staking rewards, NFT purchases, and token launches through Binance Launchpad. The Binance ecosystem had become a massive economy of its own, and BNB was the native currency fueling it all. But with fame came attention, and not all of it was good. As Binance became the largest crypto exchange on the planet by trading volume, regulators around the world started asking tough questions. Authorities in the UK, Japan, Germany, Canada, and other countries began issuing warnings, investigating Binance's operations, or outright banning certain services. The main concern? Binance was offering complex financial products like futures, margin trading, and staking without clear licenses. And while Binance claimed to be decentralized in spirit, its structure raised eyebrows. It was global, yet hard to pin down. Its headquarters? Technically, none. Meanwhile, Binance Smart Chain came under fire as well. Critics pointed out that while BSC looked decentralized on paper, the validator set was small and tightly controlled, with Binance retaining influence over who secured the network. This raised concerns about centralization and transparency, 2 big no-nos in the crypto ethos. Still, users didn't seem to care. BSC remained fast, cheap, and easy to use. And BNB? It held strong, becoming a symbol of Binance's dominance in the crypto industry. But under the surface, the pressure was building. Binance had become too big to ignore, and regulators weren't going to ignore it much longer. By 2022, Binance was firmly in the spotlight, but it was a double-edged sword. On one hand, Binance had become an unstoppable force, with BNB deeply embedded into every corner of the crypto economy. On the other hand, regulators weren't just watching anymore, they were taking action. Countries like the US, UK, and several in Europe began increasing legal pressure, demanding more transparency from Binance and questioning whether it was operating within the bounds of local laws. Binance had to adapt fast. In response, the company began changing its structure, moving away from a one-size-fits-all model and instead setting up regionally compliant entities. Binance's strategy was clear: cooperate where possible, retreat where necessary, and keep innovating globally. Amid the legal reshuffling, the BNB ecosystem kept expanding. Binance Labs, the investment arm of Binance, poured capital into emerging Web3 startups, DeFi platforms, and NFT projects, all of which integrated BNB or deployed on Binance Smart Chain. In fact, BNB Chain became the new umbrella brand for Binance's blockchain ecosystem, merging Binance Chain, the original, and Binance Smart Chain into one unified narrative. The goal was to push BNB beyond trading into gaming, metaverse, decentralized identity, and real-world applications. NFTs took off on BNB Chain, with platforms like Babylon's NFT marketplace and GameFi projects gaining traction. Even in the face of fear, uncertainty, and doubt, or FUD, BNB stayed strong, consistently ranking among the top 5 cryptocurrencies by market cap. While legal challenges dominated headlines, the user base continued to grow, especially in Asia and Latin America. This was a pivotal year. BNB was no longer just a utility token for trading fees. It had become the backbone of an entire ecosystem. But with mounting pressure from regulators, the question remained, could it survive the storm that was coming? In 2023, Binance faced what many called its biggest existential threat yet, a full-scale assault from US regulators. In June, the US Securities and Exchange Commission, SEC, filed a sweeping lawsuit against Binance and its founder, Changpeng Zhao, CZ, accusing them of operating an unregistered securities exchange, misusing customer funds, and failing to comply with US laws. To make matters worse, the Department of Justice, DOJ, began its own investigation around the same time. For the first time, Binance wasn't just facing fines or warnings, it was facing a direct attack on its core business model. The lawsuit shook the crypto world. Among other things, the SEC listed BNB as a potential security, which raised a major red flag. If courts agreed with that classification, it could force exchanges to delist BNB in the US, limit its use in DeFi protocols, and trigger ripple effects across the Binance ecosystem. Already, Binance US, the American arm of the company, had to reduce or pause several BNB-related services, including staking and certain trading pairs. Despite the chaos, Binance's global business continued operating, especially in regions less influenced by US regulations. And while the legal headlines caused short-term price volatility for BNB, the token remained widely used across the BNB chain, in DeFi, and for payment integrations around the world. Some investors even viewed the legal pressure as a buying opportunity, believing that Binance's size and influence would help it survive. But the concern was real. With the SEC, DOJ, and other regulatory bodies circling, the long-term legal status of BNB hung in the balance. If labeled a security, the impact could be massive. If not, BNB might emerge stronger than ever. But 2023 was the year the fight truly began. By the end of 2023, Binance's legal troubles reached a dramatic climax, and so did the reign of its iconic founder, Changpeng Zhao. In November, after months of negotiations, Binance reached a historic $4.3 billion settlement with the US Department of Justice. It was one of the largest penalties ever issued in the crypto world. As part of the agreement, CZ agreed to step down as CEO, marking the end of an era for the company he built from scratch into the world's largest crypto exchange. The DOJ's investigation found Binance guilty of failing to maintain adequate anti-money laundering (AML) controls, violating sanctions laws, and allowing illicit actors to move funds through the platform, while Binance did not admit to misusing customer assets. A critical distinction compared to the FTX collapse, the settlement sent shockwaves through the industry. The takeaway was clear. Regulators were no longer tolerating gray zones. CZ's departure wasn't just symbolic, it was a turning point. In his place, Richard Teng, a former regulator and Binance's head of regional markets, took over as CEO. His appointment signaled a clear shift toward compliance, transparency, and a more grown-up version of Binance. Teng's mandate was to stabilize the ship and guide the company through its new regulatory reality. For BNB, this leadership transition carried weight. While CZ was often seen as the face of both Binance and BNB, the token's core functions remained intact. It was still being used to pay for trading fees, access Launchpad events, and power activity across the BNB chain. The settlement offered Binance a chance to reset and prove it could operate within global regulations. But for the BNB community, one question remained. Without CZ at the helm, could the ecosystem continue to thrive, or would BNB's fate be tied too closely to its founder's legacy? With regulatory dust beginning to settle and new leadership in place, 2024 marked a pivotal year of rebuilding and redefining the BNB ecosystem. Binance took strategic steps to separate its centralized exchange business from the development of BNB Chain, a move aimed at demonstrating greater decentralization and reducing regulatory risk. This distinction helped clarify that while BNB remains central to Binance's infrastructure, its blockchain ecosystem has ambitions and momentum of its own. BNB Chain, now formally recognized as a combination of the original Binance Chain and Binance Smart Chain, doubled down on technical innovation. Developers focused on improving scalability and usability by launching Layer 2 solutions, enhancing EVM compatibility, and even experimenting with AI integrations. These changes were designed not only to attract more developers, but also to compete with other leading smart contract platforms like Ethereum and Solana. The BNB Smart Chain remained one of the most active blockchains in the world, with millions of daily transactions. Despite past criticisms about centralization, its performance and affordability continued to attract dApps in DeFi, gaming, and social finance. Binance Labs, the venture arm, kept fueling this growth by investing in projects that aligned with BNB's utility-focused vision. Perhaps most importantly, Binance and BNB Chain both increased focus on emerging markets. From Africa to Latin America and Southeast Asia, adoption grew as users tapped into low-cost trading, token swaps, and blockchain-based financial tools powered by BNB. These regions, underserved by traditional banking, became a proving ground for BNB's global relevance beyond speculation. In 2024, BNB Chain wasn't trying to be flashy. It was focused, fast, and functional. It rebuilt trust with developers, attracted real users, and proved that even under pressure, the ecosystem could evolve without losing its core utility. As we arrive in 2025, BNB remains firmly in the top 5 cryptocurrencies, still acting as the beating heart of the Binance ecosystem. Its utility is undeniable. Users pay trading fees with BNB for discounts on the Binance exchange, use it as gas on the BNB chain, stake it to secure the network, and participate in governance for certain dApps and protocols. In many ways, BNB has become more than just a coin. It's an infrastructure layer embedded in one of the most used crypto ecosystems on Earth. But this year also presents a key question. Can BNB thrive without becoming a legal liability? While Binance has made strides to distance itself from past regulatory troubles, including CZ stepping down and compliance reforms being implemented, the threat of BNB being labeled a security in the US still looms. If that happens, it could limit its availability on major platforms and trigger further scrutiny. Despite these risks, BNB continues to expand its presence, especially outside Western markets. In countries like Nigeria, Brazil, India, and the Philippines, users interact with BNB daily through remittances, token swaps, payments, and decentralized applications. It's even supported by Visa debit cards, allowing people to spend BNB like cash in the real world. These use cases give it staying power, even if regulators in the US grow stricter. Still, critics argue that Binance maintains too much control over validator sets and token economics, especially the quarterly burns that reduce supply. While the chain is technically permissionless, skeptics say true decentralization is still a work in progress. So is BNB a utility powerhouse or a ticking legal time bomb? The answer depends on how the legal frameworks evolve, how decentralized the network becomes, and whether Binance can convince the world that BNB is more than just an in-house token. One thing is certain, BNB isn't going anywhere, but its future will be shaped by more than just code. All right, next on the line is number 1 stablecoin in the entire world, or better known as Tether USDT. Let's get inside. All right, without wasting time, let's go at the very beginning of stablecoins. In the wild early days of crypto, where coins like Bitcoin and Ethereum moved up and down like roller coasters, one simple but revolutionary idea emerged. What if you could have a crypto token that didn't swing wildly in price? That idea became the foundation of Tether, the very first stablecoin. Originally launched in July 2014 under the name Realcoin, it was founded by Brock Pierce, Reeve Collins, and Craig Sellers. But within months, they rebranded it to a name that would soon become infamous in crypto circles: Tether. The idea behind Tether was elegant. Create a digital token that's always worth $1. Every USDT token would supposedly be backed one-to-one by real dollars sitting in a bank account. This stable price would make it easier for traders to avoid volatility, move money between crypto exchanges, and even serve as a digital dollar in places where traditional banking didn't work well. Tether initially launched on Bitcoin's Omni layer, a protocol that allowed tokens to exist on top of the Bitcoin blockchain. This made it compatible with Bitcoin's ecosystem while introducing a new type of asset that wouldn't spike or crash overnight. From day one, Tether claimed that every token issued was backed by US dollars held in reserve. That claim would later come under serious scrutiny, but at the time, the crypto world was intrigued. Tether offered something no other coin could: stability. In many ways, this marked the beginning of a new era in crypto, one where people could trade, invest, and hedge without constantly worrying about volatility. Tether wasn't just another altcoin. It was trying to become crypto's version of cash, and that was a bold idea. After its quiet debut, Tether began gaining real traction in 2016 and 2017, not because of big marketing, but because of exchange adoption. At the time, stablecoins weren't mainstream, and traders were looking for a way to protect their profits during high volatility. USDT started to look like the perfect tool. One of the biggest factors behind its early success was its deep connection with a major exchange, Bitfinex. The relationship between Bitfinex and Tether was more than just business. They shared key executives and infrastructure. Bitfinex was among the first to fully integrate Tether, offering traders a way to instantly move in and out of volatile assets without converting to fiat. This new tool became a game changer for traders. Instead of withdrawing to a bank, which could take days and involve KYC delays, they could just switch to USDT and stay within the crypto ecosystem. Fast, simple, and nearly frictionless. As crypto entered its first big bull run in 2017, Tether's usage exploded. It was the go-to stable asset for most centralized exchanges, and the circulating supply of USDT surged to match demand. Traders used it to hedge against Bitcoin crashes, move money across platforms, and settle trades without touching banks. But this rapid growth raised questions. How exactly was Tether printing so many USDT tokens? And where were all these supposed US dollar reserves being held? The company remained vague, avoiding full audits and offering little transparency. Still, the convenience was too strong to ignore. Tether became the dominant trading pair across many exchanges, second only to Bitcoin itself in trading volume. For better or worse, USDT had become the beating heart of the crypto market's liquidity, and it wasn't slowing down. As Tether's adoption surged, so did the scrutiny. By late 2017, concerns started piling up, not just from critics, but from regulators and analysts across the financial world. At the center of it all was one simple but critical question. Are these USDT tokens really backed one-one by US dollars? Tether had always claimed that every token issued was backed by reserves held in bank accounts. But when journalists and watchdogs began digging, they found inconsistencies. There was no public audit, no clear record of which banks held the funds, and at times, vague or changing statements from the company. Transparency, which should have been the foundation of a stablecoin, was sorely lacking. Then came the first big shock. In November 2017, Tether announced that it had been hacked, losing $31 million worth of USDT. The company responded by freezing the stolen tokens and issuing new ones. Something that raised eyebrows about how much control Tether had over its supposedly decentralized asset. But the real storm hit in December 2017, when a paper from University of Texas researchers suggested that Tether may have been used to manipulate Bitcoin's price during the bull run. The report alleged that large USDT issuances often preceded Bitcoin surges, implying that the tokens were being printed without proper backing and used to pump markets. Tether denied the allegations, but failed to offer the kind of independent audit that could clear the air. By now, many in the crypto community were divided. Was Tether a clever, functional tool keeping the markets liquid, or a ticking time bomb backed by nothing? Despite the drama, one thing was clear. Tether had become too important to ignore. It was deeply embedded in trading pairs, exchanges, and crypto infrastructure. Even as doubt spread, usage continued to grow. Tether wasn't just a stablecoin anymore. It was now one of the most controversial players in all of crypto. By 2018, Tether's critics were growing louder, and regulators had started to take notice. The questions surrounding whether USDT was fully backed hadn't gone away. In fact, they had intensified. And finally, the pressure boiled over into legal action. In April 2019, the New York Attorney General dropped a bombshell. It was investigating Tether and Bitfinex, alleging they had engaged in a cover-up of an $850 million loss. According to the NLEAG, Bitfinex, which shared key executives and banking infrastructure with Tether, had used Tether's reserves to secretly fill the gap left by lost customer funds. Shortly after, Tether made a major admission. Despite years of claiming that every USDT was backed one-to-one with cash, the company revealed that only about 74% of the reserves were held in cash or cash equivalents at that time. The crypto world was stunned. This confirmed what skeptics had warned about. Tether was operating more like a shadow bank, issuing billions in tokens without fully backing them with liquid US dollars. The legal fallout was swift. In February 2021, Tether agreed to pay $18.5 million to settle the case with the NLEAG without admitting wrongdoing. As part of the settlement, Tether was required to publish regular reports detailing the makeup of its reserves, a big step toward at least partial transparency. Still, the controversy didn't slow Tether down. If anything, the opposite happened. USDT usage continued to skyrocket, especially in Asian markets, where traders relied on it for quick settlement and access to US dollar equivalents in places with strict capital controls or unstable local currencies. While critics continued to call for a full, independent audit, the market kept moving. For traders and exchanges, Tether remained too useful to give up, despite the legal baggage. By the end of 2019, one thing was clear: Tether had survived its biggest legal challenge yet, but it still hadn't won back full trust. By 2019, it became clear that Tether needed to evolve beyond its original home on the Bitcoin Omni layer. Transactions were slow and costly, and with crypto markets heating up again, speed and efficiency were becoming top priorities. So Tether made a major pivot. It expanded onto other blockchains, beginning with Ethereum. This new version of Tether, known as an ERC20 token, allowed for much faster transactions and lower fees. It also meant USDT could now be used in smart contracts and decentralized finance, which was just starting to gain traction. Almost overnight, Ethereum-based USDT became the dominant form of Tether, but the expansion didn't stop there. Tether soon launched on Tron as well, a high-speed blockchain that quickly gained popularity in Asia. USDT on Tron, known as TRC20, offered near-zero fees and instant settlement, making it ideal for peer-to-peer trading, remittances, and arbitrage between exchanges. TRC20 USDT became a major player in over-the-counter crypto markets, especially in regions with capital restrictions. By the end of 2020, Tether existed on a wide range of blockchains, including Ethereum, Tron, EOS, Algorand, and Solana, making it the most widely supported stablecoin in the world. Daily trading volume for USDT regularly surpassed Bitcoin, a clear sign of how deeply it had embedded itself into the crypto economy. Despite lingering concerns around transparency and the absence of a full independent audit, users continued to adopt it because it simply worked. Tether had successfully transformed from a Bitcoin-only experiment into a multi-chain powerhouse that was now essential infrastructure for the entire crypto space. As decentralized finance, or DeFi, exploded in 2020, the role of stablecoins became more important than ever. Tether found itself at the center of a new kind of competition, often called the stablecoin wars. New players like USDC, BUSD, and DAI emerged with a focus on compliance, transparency, and integration into regulated financial systems. These rivals published regular audits and emphasized trust, exactly the area where Tether had received the most criticism. But despite that, USDT remained dominant in practice. While competitors talked about oversight, Tether was everywhere. On centralized exchanges, in DeFi protocols, and on trading desks, it was the stablecoin of choice for fast, deep liquidity. Traders used USDT as a settlement layer, arbitrage tool, and store of value, especially in emerging markets where access to dollars was limited. At its peak, USDT accounted for the majority of all stablecoin volume, by a large margin. Its integration into DeFi further solidified its utility. Platforms like Uniswap, Curve, and Aave began using USDT in liquidity pools, lending markets, and yield strategies. Although some protocols preferred more transparent alternatives like USDC, user demand for USDT ensured its continued relevance. The DeFi boom proved that, for many users, reliability and availability mattered more than full regulatory clarity. Tether had survived technical problems, legal challenges, and public skepticism. Now, it was thriving in one of the fastest-growing sectors in crypto. Even if the competition was more compliant or transparent, Tether remained the default, and it wasn't going anywhere. As Tether's dominance continued, regulators around the world started paying much closer attention. In the United States, the Treasury Department, the SEC, and other agencies began sounding alarms about the potential risks posed by stablecoins. These warnings weren't just theoretical. With billions of dollars flowing through USDT daily, regulators questioned how much of that activity was backed by real reserves, and whether Tether posed a systemic risk to both the crypto world and the broader financial system. Tether became a prime target. It was accused of lacking transparency, operating without proper licensing, and having links to shadow banking. Journalists, analysts, and lawmakers demanded a full audit of its reserves, something Tether still hadn't provided. In response to mounting pressure, Tether began publishing monthly attestations, third-party reports confirming the existence of reserves, though not with the rigor or frequency of a formal audit. One revelation surprised many. A large portion of Tether's reserves had been held in commercial paper, essentially short-term corporate debt. Critics raised concerns about the quality and origin of these papers, suggesting that if markets turned volatile, USDT could face redemption issues. In response, Tether gradually reduced its commercial paper exposure, claiming it was working to improve its reserve quality. Despite all the scrutiny, USDT continued to grow. For every headline warning about its risks, users across the world continued to transact in billions. It was a paradox. The more people questioned Tether, the more it proved its utility by simply continuing to work. But the message from regulators was clear. The era of unregulated stablecoins was coming to an end, and Tether was going to need to adapt. By 2023, the message from regulators had been received loud and clear, and Tether began to shift its strategy. The first major move was eliminating all commercial paper from its reserves, replacing it with US Treasury bills and other high-grade liquid assets. This wasn't just a symbolic change, it was a deliberate attempt to improve the quality, transparency, and stability of USDT's backing. For the first time, Tether was signaling that it intended to meet the expectations of institutional investors and regulatory bodies, even if it didn't go all the way toward full auditing. To reinforce this shift, Tether began publishing real-time reserve updates alongside quarterly assurance reports verified by third-party firms. While these still weren't the full audits that critics demanded, they were more detailed and more frequent than in previous years. The reports showed growing confidence in Tether's ability to manage reserves responsibly, at least from a risk and liquidity standpoint. As a result of these efforts, and despite all the past controversies, Tether retained its crown as the largest stablecoin in the world. But more importantly, it started to gain traction in areas where institutional trust mattered. Banks, fintech platforms, and cross-border payment systems began integrating USDT as a legitimate settlement layer. In developing countries where access to traditional banking was limited, Tether became a critical financial tool. It wasn't just a crypto trading asset anymore. It was evolving into infrastructure. Tether's actions in 2023 showed that while it might never become the most regulated player in the game, it could still move toward transparency and legitimacy, at least enough to maintain dominance in both crypto-native and traditional financial spaces. By 2024, Tether had firmly established itself as the go-to stablecoin not only in crypto markets, but also in the informal and underserved economies of the Global South. While governments and institutions in the West debated regulation and compliance, everyday people in countries like Nigeria, Turkey, Argentina, and Ukraine were using USDT as a lifeline. In economies plagued by hyperinflation, unstable banking systems, and strict capital controls, USDT became the digital dollar, a way to preserve value, send remittances, and conduct peer-to-peer transactions without relying on traditional banks. What made Tether especially effective in these regions was its simplicity and accessibility. Through mobile apps and messaging platforms, users could send and receive USDT with little more than a smartphone and internet access. For millions of people, this wasn't about speculation. It was survival. USDT offered a level of financial inclusion that local banks and even central banks couldn't match. Its dollar peg provided a level of stability that local currencies often failed to deliver. Interestingly, Tether's more relaxed regulatory posture, often criticized in developed markets, became a strength in these settings. Unlike competitors like USDC that focused heavily on compliance and licensing, Tether prioritized availability and global reach. This approach resonated with grassroots users who cared more about access than regulation. Crypto ATMs, street-level exchanges, and online peer-to-peer platforms embraced USDT as the preferred unit of account. In 2024, USDT wasn't just a crypto asset. It was a real-world economic tool embedded in parallel financial systems across the world, especially in places where traditional finance had failed. And that grassroots adoption became one of the biggest reasons Tether remained unshaken at the top of the stablecoin pyramid. By 2025, Tether had become something of a paradox, the most widely used stablecoin in the world, yet still the most controversial. Despite nearly a decade of legal battles, skepticism, and calls for full audits, USDT remained the dominant force in crypto's dollar-denominated economy. No other stablecoin came close in terms of volume, liquidity, or global reach. It wasn't just the largest, it was the default. Tether's resilience was rooted in its utility. Traders, institutions, and individuals all continued to rely on USDT as a stable base pair, a remittance vehicle, and a store of value in volatile markets. Its integration across centralized exchanges, DeFi protocols, and real-world payment networks made it indispensable. In many ways, Tether had become crypto's version of cash: liquid, fast, and hard to stop. Yet, the controversies never really disappeared. While Tether had made strides toward transparency with real-time reserve reporting and third-party attestations, it still hadn't delivered the one thing critics demanded: a full, independent audit. Regulators continued to circle, and some jurisdictions moved to limit USDT exposure altogether. But at the same time, Tether expanded its offerings, launching region-specific stablecoins like MXNT, Mexican peso, and XAUT, gold-backed, diversifying its appeal and use cases. The deeper truth was that Tether had embedded itself in global parallel economies. In developing markets, it was often seen as more trustworthy than local banks. For traders, it remained the most liquid on-ramp and off-ramp for crypto. And for institutions, despite compliance concerns, it was just too efficient to ignore. By 2025, Tether was no longer just a product. It was an infrastructure layer, a financial utility, a staple of crypto markets. Whether or not it ever becomes fully regulated or delivers a clean audit, one thing is clear: USDT isn't going away anytime soon. Next up is yet another stablecoin, main competitor of Tether, and that is none other than USDC. Let's cover USDC. To understand how USDC was born, we need to go back to 2018, a time when cryptocurrencies were booming, but also deeply unstable. Coins like Bitcoin and Ethereum could rise or fall by double digits within hours, and that volatility made them nearly impossible to use for everyday transactions. Traders and investors needed something safer, something that held steady like the dollar, but still lived on the blockchain. This is where USDC comes in. USDC stands for USD Coin, and it was launched through a joint venture called the Center Consortium, created by two giants in the crypto industry, Circle and Coinbase. Circle is a fintech company founded in 2013 with the mission to modernize finance using blockchain technology. And Coinbase is one of the largest and most trusted crypto exchanges in the United States. Together, they wanted to design a stablecoin that was not only pegged to the US dollar, but also fully transparent, meaning every single USDC token in circulation would be backed by actual dollars or dollar-denominated assets like US Treasuries sitting in reserve accounts. This was revolutionary because at the time, the number one stablecoin, Tether, was facing questions about whether it really had enough reserves to back all its tokens. By launching USDC with the promise of full backing and regular public attestations from independent accounting firms, Circle and Coinbase were setting a new standard for what a digital dollar could be. For beginners, think of it like this: Tether was the first version of digital dollars, but people weren't sure if it was telling the full truth, while USDC entered as the honest, transparent version that regulators and institutions could actually trust. And the way it worked was simple. If you deposited $1 with Circle, you received one USDC token. If you wanted your dollar back, you returned your USDC and the token was destroyed or burned, keeping the supply always equal to the reserves. This system of minting and burning guaranteed that the value of one USDC would remain stable at $1. What made the launch so impactful is that it wasn't just about creating another cryptocurrency. It was about building a bridge between traditional finance and the blockchain economy. For the first time, users had a digital dollar they could trust without worrying about wild swings or questionable reserves. That trust factor became the foundation of USDC's growth. And even though it started small, the seeds planted in 2018 would eventually grow into one of the largest and most widely respected stablecoins in the world. After its launch in 2018, USDC had to prove that it was more than just another crypto project with big promises, and that journey really started in 2019. At this stage, most people in crypto were still relying on Tether as their stablecoin of choice, but USDC slowly began gaining traction, especially among traders who wanted a safer, more transparent option. To understand why this mattered, let's quickly define adoption. Adoption in crypto simply means people and platforms actually start using a coin in real transactions rather than just talking about it. And in 2019, adoption for USDC began to spread across major crypto exchanges, wallets, and trading platforms. Traders discovered that they could use USDC as a digital shelter against volatility, meaning when the price of Bitcoin or Ethereum dropped sharply, they could instantly swap into USDC without moving their money back to a bank account. This gave them speed, safety, and stability while keeping funds inside the crypto ecosystem. Exchanges also saw the benefit because offering USDC trading pairs made it easier for users to switch between volatile assets and a stable digital dollar. As a result, USDC's supply started to grow from just a few 100 million tokens in circulation at the start of the year to well over 500 million by the end of 2019. That growth might seem small compared to today's numbers, but back then it was a major milestone because it showed that people trusted the new stablecoin enough to hold and use it daily. Still, it was nowhere near Tether's dominance. Tether had already been in the market for years and had billions circulating across multiple exchanges, so USDC was very much the underdog in its early years. But here's what made it different. While Tether was facing constant controversies about whether it truly held enough reserves, USDC was building its reputation as the clean, transparent alternative, supported by monthly attestations and strict rules around its reserves. For beginners, you can think of Tether as the loud and messy older sibling that everyone already knows, while USDC was the quiet, reliable younger sibling, slowly earning respect. By the end of 2019, the stage was set. USDC hadn't dethroned Tether. Not even close, but it had gained a foothold in the crypto world and built the trust foundation it would need for the explosive years that followed. The year 2020 was a turning point, not only for USDC, but for the entire crypto market, because this was the year of what is now called DeFi Summer. DeFi stands for Decentralized Finance, which simply means recreating traditional financial services like lending, borrowing, and trading, but on blockchain networks where smart contracts handle everything instead of banks. To make these systems work, people needed stablecoins that didn't fluctuate wildly in value, and this is where USDC became a superstar. On Ethereum, which was the main home of DeFi at the time, protocols like Compound, Aave, and Uniswap exploded in popularity, attracting billions of dollars almost overnight. Users needed a stable and transparent digital dollar to deposit into these systems, and while Tether was still the largest stablecoin, USDC quickly gained favor because of its compliance-first approach and public audits of reserves. For example, if you wanted to lend money on Compound, you could deposit USDC and immediately start earning interest without worrying that its value would suddenly drop. Or if you wanted to provide liquidity to a decentralized exchange like Uniswap, pairing tokens with USDC became the standard because everyone trusted that one USDC would always equal $1. This trust gave developers confidence too, because building financial products around a transparent stablecoin lowered the risk of collapse compared to using an opaque one. As a result, demand for USDC surged massively throughout 2020. Its total supply went from under 500 million in early 2020 to more than 3 billion by the end of the year, a growth rate that shocked even its creators. What is important to understand here is that this growth wasn't fueled by hype or speculation. It was driven by real use cases inside the new world of decentralized finance. USDC had gone from being a side player to being one of the main pillars holding up DeFi's rapid rise. For beginners, think of it this way. Before DeFi Summer, USDC was like a new store in town with only a few loyal customers. But after DeFi Summer, it became the go-to supermarket that everyone visited daily because it had what the market needed most: stability and trust. This was the moment that solidified USDC's place in the crypto ecosystem and set the stage for its battle with Tether in the years ahead. By the time 2021 rolled around, USDC was no longer a small player in the background. It had grown into a serious challenger in what many began calling the stablecoin wars. This term simply describes the competition between different stablecoins like Tether, USDC, Binance's BUSD, and decentralized alternatives such as DAI, each fighting for market share and user trust. USDC entered the year with billions already in circulation, and as the bull run pushed crypto into the mainstream, its supply crossed tens of billions for the first time, making it clear that it had firmly secured the number 2 spot right behind Tether. But with this growth came new challenges. Regulators around the world started paying close attention to stablecoins, worried that they could pose risks to the broader financial system if not properly managed. Governments asked tough questions, like what happens if a stablecoin issuer doesn't really have the reserves it claims, or how these digital dollars might impact banking and monetary policy. While this spotlight was intimidating for some projects, Circle used it as an opportunity to push its compliance-first narrative. Unlike Tether, which was facing ongoing controversies about its backing and transparency, USDC leaned into regulation and made it clear that it wanted to work hand-in-hand with governments. Circle emphasized that every USDC token was fully backed by cash or short-term US treasuries, with independent attestations published monthly. This made USDC stand out as the clean stablecoin, one that banks, fintech companies, and even regulators could trust. On the other hand, Tether still dominated global usage, especially in less regulated regions where speed and accessibility mattered more than transparency. For beginners, you can think of the stablecoin wars like two competing brands of bottled water. One brand has been around longer, it's everywhere, but people are not sure if it's always as pure as claimed. The other brand is newer, backed by clear reports and standards, and is gaining more customers who care about quality. In 2021, USDC positioned itself as the trusted brand, even if Tether remained the more widely used one. This year was also the moment when institutions began to notice USDC in a serious way, with banks and financial apps exploring how to integrate it into their systems. By the end of 2021, it was clear that USDC had become more than just a tool for crypto traders. It was transforming into the backbone of compliant digital finance, ready to expand beyond DeFi into the wider economy. In 2022, USDC took one of the most important steps in its entire history by expanding beyond Ethereum and becoming a multi-chain stablecoin. To understand why this mattered, let's quickly explain what multi-chain means. A blockchain is simply a digital network that records transactions, and there are many of them in the crypto world. Ethereum was the first home of USDC, but it had become congested and expensive, with transaction fees sometimes reaching tens of dollars. That created a problem for users who wanted to move smaller amounts of money quickly and cheaply. Circle, the company behind USDC, saw this and made a strategic move. They began issuing USDC natively on multiple blockchains, not as wrapped versions, but as real USDC minted directly by Circle. This included fast networks like Solana, Avalanche, Tron, Algorand, and later Polygon and Arbitrum, each offering lower fees and faster confirmation times. For example, sending USDC on Solana could cost fractions of a cent compared to several dollars on Ethereum. But Circle didn't stop there. They introduced a tool called the Cross-Chain Transfer Protocol, or CCTP for short, which allowed USDC to move seamlessly between blockchains. The way it worked was elegant. Instead of creating fake copies, USDC would be burned on one chain and then minted fresh on another, guaranteeing that the total supply always matched the reserves. For beginners, think of it like a train ticket system. If you want to travel to another city, you don't just make a photocopy of your ticket, you exchange it for a valid ticket issued at the new station. That way, only real tickets exist, and the system stays balanced. This multi-chain approach gave developers more freedom to build with USDC on whichever chain suited their apps, whether that was fast payments, gaming, or decentralized finance. It also gave users flexibility, since they could choose the chain with the lowest fees or fastest speeds without losing access to the same reliable digital dollar. By the end of 2022, USDC wasn't just an Ethereum token anymore. It was a true cross-chain currency living across many of the most popular ecosystems. This move strengthened its reputation as the most flexible and trustworthy stablecoin in crypto, laying the groundwork for the years to come, where interoperability became one of the biggest themes in blockchain. In 2023, USDC entered a new chapter of its history when Circle, the company behind it, assumed full control over its governance and issuance. To understand why this mattered, we need to go back to its origin. When USDC launched in 2018, it was governed by something called the Center Consortium, a joint venture between Circle and Coinbase. The idea was that having two industry giants work together would make USDC more balanced and credible. But by 2023, Circle decided to dissolve the consortium and take on sole responsibility for USDC. Coinbase remained a partner and investor, but Circle became the single issuer and governor of the stablecoin. This change simplified decision-making and accountability, because now there was no confusion about who was ultimately in charge. If regulators, institutions, or users had questions, Circle was the one fully responsible. On the positive side, this brought clarity and made it easier for Circle to push forward with its compliance-first vision. But on the other hand, it concentrated power and responsibility in one company, which sparked debate about centralization. Some critics argued that having one entity control a global digital dollar went against the decentralized spirit of crypto, while others pointed out that trust and accountability mattered more when it came to money that people used daily. At the same time, USDC's growth started to face challenges. Even though its reputation for transparency remained strong, adoption slowed compared to Tether, which continued to dominate usage in many parts of the world, especially in regions where regulations were weaker and people cared more about accessibility than audits. For beginners, you can think of this like a sports team changing from co-managers to a single coach. With one leader, it is easier to make quick decisions and set a clear direction, but all the pressure and responsibility fall on that one person. Circle stepping up as the sole governor of USDC was both a bold move and a risky one. It solidified its image as the most compliant and transparent stablecoin, but it also raised the question of whether one company could truly scale a global digital dollar while still competing with less regulated rivals. This moment in 2023 showed that while USDC had the trust of institutions, its long-term growth strategy would be tested more than ever before. By 2024, the stablecoin industry was no longer flying under the radar. Governments around the world were drafting new laws to regulate digital dollars, and USDC found itself directly in the spotlight. Regulators viewed stablecoins as both an innovation and a potential risk, since billions of dollars were moving outside traditional banks but still tied to the US dollar. For USDC, this was both a challenge and an opportunity. Unlike Tether, which had faced years of criticism for vague or delayed reserve reporting, USDC leaned heavily on its reputation for transparency. Circle highlighted that every token was fully backed by cash and short-term US treasuries, with monthly attestations from independent accounting firms. This gave USDC credibility among regulators, banks, and fintech companies that wanted assurance that their digital dollars were safe. However, being the clean stablecoin didn't automatically translate into faster adoption. While trust in USDC was high, its growth rate started slowing compared to Tether, which continued to dominate in regions like Latin America, Africa, and parts of Asia. In these markets, people often prioritized speed and availability over strict compliance. For example, a shop owner in Nigeria or Argentina facing daily currency inflation might choose Tether on the Tron network because it offered fast and nearly free transfers, even if the backing details weren't always clear. USDC, by comparison, was seen as more trustworthy, but also more tied to US regulations, which sometimes made it harder to access in places where governments had strict currency controls. For beginners, you can think of it like two restaurants in the same city. One has strict hygiene standards, clear menus, and is approved by regulators, while the other operates more freely, serving food quickly without worrying about every rule. The first is trusted by health inspectors and tourists. The second is loved by locals for its speed and price. That's exactly the dynamic between USDC and Tether in 2024. USDC was the regulator's favorite and the safest bet for institutions, but Tether remained the champion of real-world adoption in emerging economies. This year showed that while transparency built trust, it didn't guarantee market dominance. The challenge for USDC became clear: how to stay compliant and transparent without losing ground to competitors thriving in less regulated parts of the world. Here we are in 2025, 7 years after its launch, and USDC has firmly established itself as one of the most important digital dollars in the world. It is trusted, transparent, and deeply integrated into both traditional finance and decentralized finance. Every USDC token in circulation is backed by reserves made up of cash and US treasuries, some of the safest assets in the world. Circle continues to publish monthly attestations and works closely with regulators to ensure compliance, making USDC the gold standard for transparency in stablecoins. Banks, fintech companies, and payment processors increasingly use USDC for settlements, remittances, and instant transfers, while DeFi platforms rely on it for lending, borrowing, and liquidity pools. But despite all these achievements, USDC still struggles to overtake Tether as the #1 stablecoin by usage and market cap. The reason lies in geography and accessibility. In developed markets, where regulation and institutional trust matter most, USDC is often the preferred choice. But in developing economies, where millions rely on stablecoins as an escape from hyperinflation or unstable local currencies, Tether dominates because it is easier to access and widely used on cheaper, faster networks like Tron. For beginners, think of it like two versions of the US dollar. One is the official bank-approved version, clean and fully audited, used by corporations and regulators. The other is the street version, less formal but everywhere, moving faster and more freely among people who need it most. Both serve the same purpose, but in different environments. That's the reality of USDC today. It remains the most regulated and transparent stablecoin, trusted by institutions and governments. yet still operates in the shadow of Tether when it comes to global adoption and real-world use in emerging markets. The question now is whether the world will eventually shift toward compliance-first digital dollars like USDC, or if the more flexible, less transparent alternatives will continue to dominate where stability and access matter more than regulation. What's certain is that USDC has already carved out a permanent role in the crypto ecosystem, and its story is far from over. And our 10th and final currency for today is king of all meme coins, Dogecoin. You will be able to understand everything about it, including Elon Musk's involvement with it, if you stay until the end. Back in 2013, two software engineers, Billy Marcus from Oregon and Jackson Palmer from Australia, decided to create a cryptocurrency as a joke, not as a serious financial product. At that time, Bitcoin was already making headlines, but most people saw it as complicated and intimidating. Marcus and Palmer thought it would be funny to make a coin that was silly and approachable, something that mocked the seriousness of the growing crypto world. To make their parody stand out, they used the image of a Shiba Inu dog, which was part of a viral internet meme known as Doge. This meme showed a fluffy dog with captions written in broken English, like "such wow" and "very currency." That internet humor was instantly recognizable to millions of people online. They called their creation Dogecoin, and at first it was nothing more than a playful experiment. But something unusual happened. People actually started using it. Dogecoin worked on the same basic blockchain technology as Bitcoin, meaning it could be sent from one person to another without a bank in between. It was fast, cheap to use, and easy to understand. Suddenly, the coin that was meant to make people laugh became a real digital currency with a growing community. Early adopters liked it because it felt less intimidating than Bitcoin and more fun to share. It quickly attracted attention on Reddit and other online forums, where users began tipping each other small amounts of Dogecoin just for posting good content. This showed that even a coin that started as a joke could actually find practical use as a friendly and simple online currency. For many people, Dogecoin was their very first introduction to the world of crypto. It proved that sometimes humor and culture can be just as powerful in driving adoption as technical innovation or financial ambition. And that laid the foundation for everything that would follow in Dogecoin's surprising journey. By 2014, Dogecoin had grown far beyond the joke its creators intended, and it became the first cryptocurrency to truly build an identity around its community rather than its technology. While Bitcoin and other coins were often associated with speculation and serious financial debates, Dogecoin's users embraced kindness, generosity, and fun as their guiding principles. On Reddit, Twitter, and various online forums, Dogecoin holders started using the coin for tipping, which means sending small amounts of Doge to reward good posts, memes, or helpful comments. This made Dogecoin feel like an internet currency for everyone, not just a tool for traders. What really set it apart, though, were the large-scale fundraising efforts that made global headlines. In early 2014, the Dogecoin community raised around $30,000 worth of Doge to sponsor a NASCAR driver named Josh Wise, who ended up racing with a car covered in the Dogecoin logo, turning the meme into a real-life marketing spectacle. That same year, the community raised over $50,000 to help the Jamaican bobsled team compete in the Winter Olympics after they had qualified but lacked the funding to attend. For beginners, these examples show why Dogecoin is often called the first community coin. It wasn't about having the fastest blockchain or the most advanced features. It was about the people who believed in it and the positive energy they created together. This sense of unity gave Dogecoin a reputation as the fun coin that could still do serious things. Even though its creators never expected it to reach such heights, the community spirit around Dogecoin made it stand out in a space otherwise dominated by technical jargon and financial speculation. In fact, many people who had never cared about crypto before found themselves drawn in by the friendliness of the Dogecoin movement, proving that culture and community can sometimes be more important than code. This year cemented Dogecoin's place as more than just a meme. It became a living example of how collective enthusiasm can turn a joke into something with real impact on the world. After the excitement of 2014, Dogecoin faced a much tougher reality in 2015 and 2016, a period often called the crypto winter. The term crypto winter describes times when interest in cryptocurrencies drops, prices fall sharply, and many projects simply die off due to lack of support. For Dogecoin, this was an especially challenging time because both of its original creators stepped back from active development. Jackson Palmer publicly criticized the hype and speculation surrounding the crypto industry and left the project entirely, while Billy Marcus had already moved on earlier. With no strong leadership and little technological advancement compared to other coins, it seemed like Dogecoin might fade into obscurity. Yet, something unusual happened once again. Instead of collapsing, Dogecoin's grassroots community kept it alive. Developers who cared about the project continued maintaining the blockchain so that it remained functional, and fans kept using Dogecoin online, mostly for tipping and small donations. This period highlighted one of the key strengths of Dogecoin. Its survival didn't depend on a company, a founder, or even major investors. It survived because ordinary people believed in it and refused to let it disappear. Many other meme coins that were created around this time quickly vanished once their short-lived hype ended. But Dogecoin's unique culture gave it staying power. For beginners, this was a lesson in how crypto projects live or die, not just based on technology, but on community support. Even when prices were low and no one outside the core fans seemed to care, Dogecoin kept going. This resilience built a kind of underground respect, because while critics laughed at its origins as a meme, the fact that Dogecoin refused to die proved that it had something real at its core. By the end of this quiet period, Dogecoin had established itself as a survivor, a coin that could weather downturns and still maintain its identity, setting the stage for its surprising reemergence during the next bull run. The year 2017 brought one of the biggest moments in cryptocurrency history, often referred to as the Great Bull Run, when prices of nearly every digital asset skyrocketed to levels nobody had imagined before. A bull run simply means a period where markets are rising rapidly, driven by new money and overwhelming excitement. Bitcoin and Ethereum were at the center of attention, but Dogecoin unexpectedly became one of the surprise stars of this wave. Even though the coin still had almost no formal development team and was considered by many experts as outdated compared to newer technologies, its price surged along with the rest of the market. For many beginners, this was the first time they heard about Dogecoin, not just as a meme, but as an asset that could make people money. Its low price per coin made it attractive for new investors who felt they had missed out on Bitcoin, and communities on Reddit and Twitter continued spreading the fun-loving Doge culture, drawing in fresh supporters. Critics at the time dismissed this rise as nothing more than speculation, arguing that Dogecoin had no serious technological upgrades, no white paper roadmap, and no foundation behind it. Yet, the market showed that popularity and brand recognition can sometimes matter just as much as innovation. Dogecoin benefited from being seen as approachable and less intimidating than coins with complicated explanations, which helped it spread among first-time buyers. While other projects were fueled by promises of new features, Dogecoin's simple identity as the internet's fun currency became a strength of its own. By the end of 2017, Dogecoin had shocked even its harshest critics by climbing into the list of most valuable cryptocurrencies. Although it did not stay near the top once the hype cooled down, this period proved that Dogecoin had the ability to capture global attention and rise with the market, despite lacking the kind of structure or seriousness usually considered necessary for long-term success. After the explosive highs of 2017, the cryptocurrency market entered another downturn, and prices across the board collapsed. This period is often described as a bear market, the opposite of a bull run, where enthusiasm fades and investors lose interest. Many coins that had briefly risen to fame during the hype completely disappeared, but Dogecoin once again proved it had something different. Even though its price dropped heavily like the rest of the market, the culture around Dogecoin continued to grow stronger, especially on the internet. Its role as the fun and approachable crypto coin made it perfect for online communities that wanted to keep spirits up during tough times. People continued using Dogecoin for tipping each other on Reddit and Twitter, rewarding good content with small amounts of Doge in a way that felt playful and social rather than purely financial. The community also organized charity efforts, raising money for causes ranging from clean water projects to helping service dogs for children in need. While most cryptocurrencies were trying to convince investors with complicated roadmaps, Dogecoin kept thriving because it leaned into what it was best at, being a meme. In internet culture, memes are not just jokes. They are ideas that spread fast and stick in people's minds. Dogecoin embraced this fully, turning its Shiba Inu mascot into one of the most recognizable symbols in the entire crypto world. For beginners, this shows how value in crypto is not always about technology, but can also be about identity and community. Dogecoin had no groundbreaking upgrades during these years, yet it stayed alive because people enjoyed being part of the joke that somehow kept going. By 2019, it was clear Dogecoin was not fading like the countless other meme coins that had been created. Instead, it was becoming an icon of internet culture, building momentum that would later explode into mainstream attention once one very influential supporter joined the fun. By 2020, Dogecoin had already established itself as a resilient internet coin with a loyal community. But everything changed when the richest person in the world, Elon Musk, began publicly mentioning it. Musk, known as the CEO of Tesla and SpaceX, had already built a reputation for being active on Twitter, where he often shared memes and unusual thoughts with his massive audience. When he started tweeting about Dogecoin, sometimes calling it the people's crypto, or joking about sending it to the moon, the effect was immediate. Each tweet would cause Dogecoin's price to spike within minutes as millions of people rushed to buy, believing that if someone as powerful as Musk supported it, the coin must have a future. This phenomenon became known as the Elon Musk effect, a rare example of how a single influencer could dramatically move markets in real time. For beginners, it is important to understand why Musk's involvement mattered so much. His image as an innovator who built electric cars and rockets gave Dogecoin a level of credibility it had never enjoyed before, even if his comments were mostly playful. Media outlets around the world began covering Dogecoin simply because Musk kept bringing it up, and this exposure reached audiences far beyond the usual crypto community. At the same time, critics argued this was dangerous because Dogecoin still lacked serious development or clear use cases, and its sudden surges were being driven more by hype than by fundamentals. Still, the excitement was undeniable. What had started as an internet joke was now being promoted by the most famous entrepreneur on the planet, and that created a sense of possibility that Dogecoin could become something much bigger than anyone had imagined. In 2020, Dogecoin transformed from being just a community meme coin into a mainstream cultural phenomenon, all because one influential figure decided to make it part of his online persona. The year 2021 was when Dogecoin truly went from being a fun internet coin to a household name, riding what became known as the to-the-moon hype cycle. This phrase, popular in trading communities, means a belief that a coin's price will rise so high it seems like it is heading to the moon, fueled by social media platforms like Reddit, TikTok, and of course Elon Musk's constant tweets. Dogecoin's price skyrocketed from less than 1 cent at the start of the year to an all-time high of around 73 cents in May. This made Dogecoin briefly one of the 5 most valuable cryptocurrencies in the world, with a market capitalization in the tens of billions of dollars, a number that represents the total value of all coins in circulation. Ordinary people who had never thought about crypto before were suddenly buying Dogecoin because it was cheap, funny, and being talked about everywhere. It became part of the larger meme stock movement, where online communities coordinated to push up the value of assets like GameStop and AMC as a way to challenge traditional finance. Musk even referenced Dogecoin during his appearance on Saturday Night Live, one of the most watched comedy shows in America, which drew millions of new eyes to the coin. However, this explosive growth also came with warnings from critics who said Dogecoin had entered bubble territory, meaning its price was far above any reasonable value and driven mostly by speculation. For beginners, this was a perfect example of how hype and community energy can create massive rallies in crypto, but also how risky it can be when prices rise too fast without underlying utility to support them. Even though the price eventually fell after the peak, Dogecoin's 2021 run cemented it as more than just a joke. It showed that memes combined with global attention could move billions of dollars and turn a once-forgotten project into one of the most talked-about assets in the financial world. After the dizzying highs of 2021, the year 2022 brought Dogecoin back down to earth, marking what many described as a reality check. In financial terms, this was the start of another bear market, a period when prices consistently fall and excitement fades across the entire crypto industry. Dogecoin, which had once been at the center of global attention, saw its price drop sharply from its all-time highs, losing more than 80% of its value by the middle of the year. Critics pointed out what they had been saying all along. Dogecoin had very little ongoing development, no clear business model, and very limited real-world use cases beyond speculation. Without constant hype from social media or celebrity endorsements, there was little reason for new buyers to keep pouring in. At the same time, broader events in the crypto industry made the situation worse. Several large projects collapsed in 2022, including major stablecoins and lending platforms, which shook trust across the market. As money drained out of crypto, coins like Dogecoin were hit especially hard because they were viewed as less serious investments. For beginners, this period showed the other side of crypto markets. Just as prices can soar quickly with hype, they can crash just as fast when confidence disappears. Yet even in decline, Dogecoin's community refused to give up. Online supporters kept making memes, tipping each other, and spreading positivity, showing that the culture around Dogecoin was still alive, even if the price was not. This loyalty became one of the coin's defining traits, separating it from other meme projects that completely vanished once the excitement was gone. While 2022 reminded everyone that Dogecoin lacked strong fundamentals, it also proved that it was not just another disposable internet joke. Its fan base treated it more like a cultural movement than a financial product, which is why it continued to survive even when many expected it to disappear for good. In 2023, Dogecoin began taking small but meaningful steps toward proving that it could be more than just a meme. Developers released updates to Dogecoin Core, which is the main software that runs the network, improving its security, efficiency, and reliability. While these technical upgrades may not have been flashy, they were important for keeping the blockchain stable and showing that the project was still being maintained. More importantly, discussions around using Dogecoin for real-world payments started gaining traction again. For years, Dogecoin's low transaction fees and fast confirmations had made it appealing for sending small amounts of money, but very few companies accepted it. That began to change as rumors circulated that Musk might integrate Dogecoin payments into Twitter, which he had rebranded as X. Although no official large-scale integration happened in 2023, even the possibility of Dogecoin being used on such a massive social platform reignited interest in its utility. At the same time, smaller businesses and online merchants began experimenting with accepting Dogecoin, not just as a novelty, but as a legitimate payment method. For beginners, this showed an important shift, because the difference between a speculative asset and a useful currency lies in whether people can actually spend it for goods and services. Community developers also worked on tools to make Dogecoin easier to use in wallets and point-of-sale systems, further supporting its potential as digital cash. While these moves were modest compared to the massive hype cycles of the past, they represented progress toward a vision of Dogecoin that could exist beyond memes and speculation. 2023 was a year where Dogecoin reminded the world that despite its playful origins, it had the technical foundation and loyal user base to support real transactions. Whether it would grow into a widely used payment system remained uncertain, but the groundwork for that possibility was finally being laid. In 2024, Dogecoin found itself facing new challenges that had less to do with technology and more to do with the changing environment around cryptocurrencies. Governments and regulators around the world began paying closer attention to digital assets, especially coins seen as highly speculative. In simple terms, regulation means creating rules and laws that control how cryptocurrencies can be bought, sold, or used, often with the goal of protecting investors and preventing fraud. While Bitcoin and Ethereum were often treated as the more serious projects with potential long-term use, meme coins like Dogecoin and Shiba Inu were frequently highlighted in regulatory discussions as examples of risky investments. This scrutiny made it harder for Dogecoin to expand in certain markets, since exchanges and payment processors had to ensure compliance with stricter rules. At the same time, competition from other meme coins became stronger than ever. Shiba Inu, another dog-themed coin, built a large ecosystem with tokens, NFTs, and even plans for its own blockchain, attracting many users who wanted more than what Dogecoin was offering. New meme coins continued to pop up, each trying to capture attention with viral marketing or clever themes. For beginners, this competition is important to understand, because unlike Bitcoin, which has a unique first-mover advantage, meme coins rely heavily on community hype and brand recognition. Dogecoin's advantage remained its status as the original meme coin, with the most recognizable brand and a loyal fan base. But it was no longer the only player in the space. Despite these pressures, Dogecoin continued to survive because of its strong cultural identity and the possibility of future integration into larger platforms like X. However, the combination of regulatory pressure and growing competition meant that Dogecoin had to work harder than ever to prove it was not just a relic of internet humor, but a coin with staying power in an increasingly crowded market. Now, in 2025, Dogecoin has been around for more than a decade, making it one of the oldest active cryptocurrencies despite its meme origins. This longevity alone is impressive, considering thousands of coins launched after Doge have already disappeared. The big question now is whether Dogecoin should still be seen as a cultural joke or whether it has a chance to evolve into true digital cash. On one side, critics argue that Dogecoin has never shaken off its roots as a parody. They point out that its technology is relatively basic compared to modern blockchains that support smart contracts, decentralized apps, and advanced scaling solutions. They also note that aside from being used for tipping, donations, and occasional payments, Dogecoin still lacks widespread real-world utility. On the other side, supporters argue that Dogecoin's simplicity is exactly what makes it powerful. It does not try to be everything at once. It is simply a cheap and fast currency that anyone can use. With transaction costs that are fractions of a cent, it is more practical than Bitcoin for small day-to-day transfers, and its brand recognition is unmatched. Everyone from beginners to seasoned traders knows what Dogecoin is, and that kind of awareness is something most cryptocurrencies can only dream of. Rumors of integration into major platforms like X, whether they fully happen or not, show that people still see potential in Dogecoin becoming a widely used payment option. For beginners, the important takeaway is that Dogecoin has already proven something remarkable. Memes can shape financial history. It showed that money is not only about math or code, but also about culture and belief. Whether Dogecoin ultimately becomes a serious contender for everyday payments or remains more of a symbolic internet treasure, it has already secured its place in the story of cryptocurrency. In 2025, Dogecoin is no longer just a joke. It is proof that communities and culture can turn even the simplest ideas into movements worth billions. Wow, you made it to the very end of this ultimate guide. I can see that you are serious about your crypto education. If that is the case, make sure to check one of these two videos you see on the screen right now. World of Crypto is moving faster than ever before, and it is perfect time to position yourself and secure your future. Hope you enjoyed the video, and I will see you in my next video.